You do.
I would request Mr. Sumanta Chaudhary, Dr. Indra Dey, Dr. Ronojoy Bhattacharya, and Dr. Vivek Roy Chaudhary to take their seats on the stage. The Conclave is a student-driven initiative and is the flagship event of the Department of Economics, Indian Institute of Foreign Trade. The highlight of the Conclave will be addresses by the Chief Guest of Honor, Mr. Sumanta Chaudhary, former Secretary, Government of India, and our keynote speaker, Mr. Siddharth Sanyal, Chief Economist, Bandhan Bank. We also have two panel discussions slated to be held on each of the days on key themes, including global value chains and general. The conclave was envisaged in its physical form last year and has scaled up immensely since then. In 2023, we had over 80 students participating from across the country. And this year, we are proud to share with you that we have over 200 students participating in the 4 student events planned as part of the conclave. The events include an economics quiz hosted by our very own homegrown quiz masters and a policy debate which would be judged by our esteemed invited professors. Both the quiz and debate will be held today. The paper presentation for masters and PhD scholars and a committee simulation of Lok Sabha will be held tomorrow, followed by a special lecture by Dr. Sugata Marjan, distinguished professor IIFT, and finally, we shall conclude the conclave with a valedictory ceremony. Before we begin, I would request Priti to please felicitate Mr. Sumanta Chaudhary. I would request follow me to felicitate Ronojoy sir. I would request Shatoki to felicitate BRC sir. I would request Anthony to felicitate Ondrila ma'am. Now I would request Dr. Ondrila Dey, the convener of this year's conclave, to say a few words.
Very good morning to all of you, especially to the students who have joined us today here from outside IIFT. A very warm welcome. A special thanks to our Chief Guest of Honor and keynote speaker who is going to join us very soon. As Ahana has already mentioned, I will not take too much time to talk about the conclave. So it's a second physical version of this conclave where we'll see a lot of participation from students primarily, and the theme of this conclave is on the politics, gender dimensions, and economics. As we all know that more than half of the global population is going to vote this year. So already in India, the voting season has begun. It's going to end with the US election. So there's going to be a lot of changes which is going to happen. Dynamism is there, which is happening for quite some time across the globe. And as students of economics, we always start our understanding from utility maximization and profit maximization functions. But we usually do not take under consideration about the environment, which is mostly politically driven now. So the role of political economy has become immensely important over time. I'm sure if not now, then probably in a few years, political economy courses are going to be introduced in undergrad itself. So when we were students, like you, so we always had this belief, and we had been believing on the Miller's idea that world is not going to get to a war. We'll not get to see wars anymore after World War II. The understanding was that people are going to perceive that peace is something that's going to be more limited, because people are going to be more patient and they can see over time the future valuations and the losses that they have seen, for which the discount factor is going to be high for it, and in game theoretic outcome would be peace, and not war anymore. So physical war was something that we thought that it's not going to happen anymore. It's going to be an economic war, not with missiles but with tariffs. But as we couldn't have perceived earlier also about the ideas of climate change, and we had only been interested in environmental economics to get higher scores and not to actually understand environment so well, it clearly gives out this idea that we are not really very good foreseers, and we are myopic. So probably that is the human behavior which is there guiding us through all the dynamics that we can see, and that has its own economic consequences. So that's the broader theme. So, and we shouldn't forget the developmental aspects associated with the economics aspect, and one of those is gender, is what has been taken up as important aspect in this conclave. So all the sessions are going to be around this theme. I'm sure that we are going to all learn from this 2-day long event. Again, a warm welcome, and for our students from outside IIFT campus, I hope you will have a good time. And if this 2-day long event interests you and you feel that you need to take up more interest in international economics and finance, the doors will be open soon for you all. We will want to have you inside the campus also. Thank you.
Thank you so much, ma'am. We know that without your guidance and support, we wouldn't have been here, and this conclave wouldn't have taken the shape it has. And now I would request Dr. Anuja Bhattacharya, the Head of Department of Economics, IIFT, to share his thoughts.
Well, welcome to IIFT. And first of all, let me make it clear that this is not teachers' event, so we are intruders here. It's all your event, students' events, and a lot of planning has gone into this. I think you're quite aware that the relevance of this kind of program, conclave, mock Lok Sabha, and the awareness that we are trying to spread about the environment. All these things are very relevant today, and especially relevant is international trade, geopolitics. So outside influences have become more important than domestic issues in many cases in many parts of the world. So the relevance of trade, flow of goods, flow of money, all this is increasing, but also the relations across countries is changing. China is coming up. India is perceived by USA as a possible large country who can compete a little bit with China. So USA, India is in a bit of a sweet spot. Everyone wants to quote India now. And so all these developments are very exciting developments. We did not have all these when we were in our when we were students. So I would request you to take these issues up in much more detail, discuss them, debate them, think what is best for the country, think about what is going on in the world. And all this will go on during these 2 days here. Thank you very much.
We welcome our keynote speaker, Mr. Siddharth Sanyal. So you can keep yourself and come on the stage. Yes, sir. I would request Devanita to please felicitate sir.
Thank you, sir.
I now move on to introduce our chief guest of honor, Mr. Shumanta Chaudhary. Sir is a retired IAS officer of the 1985 batch with 36 years of experience in public administration and has served the Government of India as the Secretary of Ministry of Coal. He has also served as the Managing Director, Small Farms Agribusiness Consortium, amongst others. A distinguished civil servant, his contributions span critical disputes, trade negotiations, and scholarly publications, cementing his legacy as a foremost authority in the field. Further, he has represented India as its chief negotiator at the WTO forums and has been a key negotiator for RCEP India, EU BTIA, India ASEAN, India Malaysia CECA. Sir has also been a rank holder of Delhi School of Economics and St. Stephen's College. Today, therefore, we are privileged to hear him speak and gain insights from his experience and knowledge. The topic of the lecture is the recent trend of deglobalization and its impact on global value chains. I would request the audience to welcome sir with a round of applause. The stage is all yours.
Faculty of IIFT, Mr. Siddharth Sanyal, and most importantly, dear students. It's in some sense a homecoming because when I was posted in Bengal, I used to come quite often here and also interact both with faculty, with Dr. Rangarajan and many of you. So thanks to the organizers for, in some sense, bringing me back, and I come back and see, of course, a much more vibrant and lovely campus. So congratulations, first of all, to the IIFT Kolkata for putting this together. Secondly, I think it's important, and before I get into this topic of so-called deglobalization and the global value chains, let me just begin by saying that before I do that, perhaps it's important to just do a little bit of a flashback. I'm afraid that that flashback, actually, none of you would have been born. And I'm talking about the birth of the WTO in 1994, which is exactly 30 years. And that's when the current global sort of structure which was honed since the Second World War with the coming home of the three Bretton Woods institutions, the IMF, the World Bank, and in those days it used to be called the GATT, the General Agreement on Tariffs and Trade, which then got into its new avatar, which was the World Trade Organization in 1994. And this was a complete change in a sense because this was the first time that multilateral trade rules were brought in not just for merchandise, but more importantly, for what are now absolutely critical services and intellectual property. And the birth of the modern trade regime actually started in the 90s. And since then, of course, it's been a long journey, and I'll come to that. And it's the whole world, in some sense, has turned topsy-turvy since those days. Those were the days when multilateralism was at its core. Countries, by and large, believed in the value of a rules-based system, which meant that their own sovereignty obviously was ceded. Unilateralism was not the way to go, and therefore the WTO trade architecture was the way that the world would prosper and hopefully become more inclusive. A lot of that has happened, plenty of that has not happened. And that's where I think the problem begins. But it's important to realize this. The second watershed which happened in the world economy was 2001, when China was included in the WTO at Doha in what was called the famous or infamous Doha Ministerial Conference, which actually brought about the demise in some way of certain issues which developing countries particularly, and why I'm saying this, that today those same issues have come back, and these are nothing but investment, government procurement, competition policy, and so on. Now, China by that time had already started to emerge as one of the leading trade nations of the world, and very soon it not only was able to actually embrace the WTO and its multilateral rules, but perhaps to the surprise of the US, actually became perhaps the biggest beneficiary of the WTO. And that's where the tussle between the US and China started. And US started to lose its hegemony over world trade. China was not only becoming the largest exporter in the world, but was also becoming the largest factory in the world. And huge number of multinational companies, the Fortune 500, were all setting base in China, investing in China. Production was now getting geographically totally dispersed. So the value chain concept became one of cost arbitrage and geographical spread. So nobody minded if, for example, an Apple iPhone had hundreds of countries preparing components. So that's the kind of value chain that started to emerge, where distances were not really the factor. The factor was economic entirely and largely cost arbitrage. So that's the kind of scenario that existed in the world somewhere till the 2010s. Then happened the financial depression of 2008-9, which again brought in some sense the backlash against globalization, which by then had started in the US, EU, and many other countries. And the reasons of backlash were slightly different in the developed and the developing world. The backlash in the US largely started from the loss of domestic manufacturing jobs in the US. And there are large cities in the US which actually became, in some sense, ghost towns as industries just disappeared. And offshoring became the mantra of globalization. Second, the US realized that the WTO, with its unique dispute settlement system, it was the first experience in public international law where the dispute settlement was not only binding on the members of the WTO, you had the possibility of retaliating if a member of the WTO who had lost a dispute did not implement the rulings of the dispute panel or the appellate body. And this experiment, US thought, was perhaps something that worked to its favor, but it suddenly started to realize that a large number of the so-called appellate body rulings of the WTO were going against it. And therefore, they felt that many of their unilateral laws were under threat. And that's when, because of both these tensions, the US started underplaying and undermining the WTO. And today, it has reached a situation where bipartisan, it has nothing to do with Donald Trump, it has nothing to do with Joe Biden, it is a bipartisan belief that the WTO is no longer the institution that will serve the US. So this was one side of the story. The second side of the story was a large number of developing countries, including India, felt that the WTO had not done what it was meant to do, which was to mainstream development and developing countries, and that largely the benefits had been cornered by the advanced world and, well, to some extent, China. So therefore, they wanted to, in some sense, revisit some of the agreements in the WTO, some of the ways in which trade rules were apparently biased against the interests of the developing world, and so on. But third thing which happened by then was the fact that global production started to have another dimension to it, which was the dimension of technology. And this was a disruptor in the entire paradigm of trade and production chains, and continues to be a disruptor, and perhaps will continue to be a disruptor. A disruptor not in a negative sense, but a disruptor in the sense that ways in which you were used to doing business and trade are no longer relevant or key. And therefore, the whole digitalization of trade, digitalization of economy, and most importantly, technologies, whether now it's AI, whether it's a 3D printing, whether it's robotics, all this has changed the concept of comparative advantage that you would have all learned in your theories of international trade in a way that has never been seen before. A final point which has then happened is, by this time, since about after 2010, in fact even before, the world realized that there was another major threat that was confronting the world, and that was climate change. And therefore, environment and climate change mitigation became, in some sense, central to whatever you did. And today, you hardly have any kind of agreement, whether it's a trade agreement in the conventional sense, whether it's an economic partnership agreement, which does not cover this important phenomena of what is now called sustainable development. But Sustainable development has number of pillars. Now, why I'm saying all of this, and I'll come to this, that all these factors have had a huge influence on the way today global value chains are seen and what it implies for trade and businesses when you look at all these paradigms. So, what has happened, and I'll give you two examples of the climate change. Many of you might have heard of a so-called regulation in the EU called the Carbon Border Adjustment Mechanism, or CBAM as it is popularly known. This is simply an instrument which is unilateral, which is aimed to further the environmental goals of the EU, but ends up being a trade instrument that amounts to an additional carbon tax on all imports into the EU starting from 1st January 2026. For the time being, it's for the most so-called polluting in terms of carbon emissions: steel, aluminium, cement, fertilizers, hydrogen, electricity generation, and so on. And over a period of time, till 2034, this will extend to other commodities as well. Now, what does it mean? It implies that if you want to export these commodities into the EU, you will have to pay the equivalent of the carbon border tax, which domestic EU producers are required to pay for what? Because EU has nationally determined, and the word is nationally determined, its contribution to emissions as 55% reduction by 2030 and net zero carbon emissions by 2050. Compare it with India, we are supposed to do it by 2070. Now, this implies that any exporter from India, unless they are able to prove two things: one, that India has either an equivalent carbon trading and carbon pricing mechanism, which acts like a tax on carbon emissions, and there is a way of measuring this, then there could be an offset. Second, this entire thing is down the value chain. So, for example, if an importer from EU is getting a steel product from India, but the producer in India is in turn importing the steel from Korea or Japan, this traceability of the carbon border will happen right through this supply chain. And if you miss parts of the supply chain, which means you would have to pay a higher carbon border tax. The fact that I'm trying to say, the second example of this is the so-called environmental, social, and governance norms, the ESG norms today, which largely are private, but in many cases are now becoming at least semi-mandatory. And what they do mean is that suppliers, or if you want to integrate into a value chain, if you don't meet these targets, there is every likelihood that the value chain will bypass you, and somebody else who complies with these norms will be in a better way to perhaps be integrated into this value chain. Now, one other thing that has been happening since, it started again with US, and that was the growth of regionalism and what are called today as free trade agreements, regional trading arrangements, and the lot. What they have done is they provide countries who are signatories to these some preferential treatment, which is, of course, a violation of the fundamental principle of WTO, which is, as you might be knowing, the most favored nation, which means treat all members of the WTO equally. But regional trading arrangements allow you to discriminate. Now, what has happened is initially they started with two things. First, the NAFTA, which was an agreement between the US, Mexico, and Canada, and the big one, the EU, the birth of Europe and EU itself as a customs union, which was in some sense the highest trade integration that you could think of. And then this side of the world, you had the ASEAN. Now, all these preferential arrangements also have started now to go well beyond trade, and they go into spaces which earlier would never have been dreamt of. You will have digitalization, you will have digital trade, you will have sustainable development, you could have human rights, and name it. So today, trade and global value chains are not just about trade. So on the one hand, geopolitical, economic, and strategic interests often determine the spread and the nature of GVCs. And here, certainly the disruption which the pandemic caused completely changed the paradigm as well. As I said, the geopolitical tensions were already existing. China was beginning, to some sense, being seen as a threat by US, EU. Unilateral tariffs had been imposed. We have heard of the China-US trade war. But what all this did was that global value chains therefore took a hit in some sense. China, of course, continued in some sense to build its own capacities, to build its own infrastructure to the extent that they had excess and surplus virtually in every single item. The other thing which it did was the concept of offshoring. One, you had the backlash against globalization or deglobalization or reglobalization, as some would term it. And then you had the need to ensure that supply chains were now no longer tied to the concept of simply the most economical and cost arbitrage. Other considerations, and now you have terms which you have seen since the pandemic: friendshoring, nearshoring, trusted partners, etc., have become the order of the day. Simply put, it means don't put all eggs in one basket. Diversify. Easier to do than to say, because this has been built over the twin levers of trade and investment, as I said. So China was not just a leader in trade, it also attracted the maximum investments and the lead firms of the global value chains, getting their production bases into China. So now, how do you actually move out and begin to diversify, begin to de-risk your supply chains? Call it supply chain resilience, call it supply chain risk mitigation. So this whole story of what is now called, quote unquote, the China plus one strategy. And what has this led to? It has led to two things which are very important. The first, as I said, I have described the unhappiness of the US, to put it very lightly, with the World Trading Order, which they themselves had created and were the largest beneficiary. So one, they have moved out of that and they have created space for what is called today an Indo-Pacific economic framework, which means a foothold in the Asia-Pacific, minus obviously the one country, which is the target. Now this is a 14-member led bloc, which US leads and India is very much a part of it. And just 2 months before, in February, the IPF has signed the supply chain agreement, which aims to put into actual practice these very principles that I just enunciated. How do countries in their defined sectors of critical or strategic interest diversify? One is, if there are alternative sources within this 14-member bloc, can they trade more with each other? Can they invest and relocate in each other's territories, particularly the lead firms, in order to carry this forward? Third, in case there are vulnerabilities, what kind of actions collaboratively can you take to prevent those vulnerabilities becoming a stumbling block, as we have seen in the pandemic, whether it is the chips, whether it is the APIs for pharma, and so on. And finally, one more, and that's actually been brought into much sharper focus the last 1 year, or 2 years in fact. First COVID, and now these wars, which have thrown the logistics completely out of whack. So one is the concentration, the second is conflict zones and other kinds of geopolitical tensions, which may render the most economic route to be infeasible, which means you would have to find alternatives that are perhaps costlier, that perhaps require greater cooperation, and perhaps require a lot of geopolitical, if I can use the word, persuasion in order to get that. So this is a third thing which has happened in the supply chain framework. Now, all this now come. Where does India fit into all of this? And where is India's GVC? Now, the fact is that in some sense, India's integration intentionally, and I use this word very clearly, into the global value chains has perhaps in the past not been commensurate with its economic strength. That is changing. So one, what are those factors? First and foremost, because you are now looking at relocating industries, preventing concentration, but at the same time having a large, vast and secure market, then what better than India? And therefore, whether it's the story of the Apple and mobile production in India, today, of course, it's crossed $11 billion in 2023 of mobile phones, and we are now becoming one of the largest exporters of mobile phones. But essentially, the lead firm has invested in India through its contract manufacturers, even though it's a fact that the components of the Apple iPhone which are manufactured in India still come from many other parts of the globe. But there is a possibility that more and more of these contract or subcontract will actually start to get into India, and the local content of the iPhones in India, which is nothing but actually integration into a global value chain, will happen. The second way, of course, is the entire, and here the concept of using India as an investment destination, not just for the domestic market, but for the entire world. So then you have things like Make in India, the PLI scheme, and so on, which essentially are to attract the lead firms to invest, use this as the domestic manufacturing hub, and then export. And by the way, this is something which is not new. Many may not realize, but this is exactly what has happened with the Indian automobile story, which started in the late 90s. And today, It was when the auto manufacturers started to look at India as a market. Initially, the intention was to come into India through a trade route. So simply export their cars or whatever. But India chose a route which was actually to attract them to start manufacturing, invest in India, and this was largely done by first the Japanese and Korean firms, starting with Hyundai in the late 90s. Now they started using this as the base, and then it became the export hub for many, many models of the Japanese and the Koreans, and then finally the EU car makers and the US car makers have followed. So essentially, it was the same model which was first invest and then use this as the basis for trading, not just within, but to all parts of the world. Regional trading arrangements provide you that second scope, which is now changing the paradigm of world trade and investment. And let me take a very recent example. I don't know how many of you have followed, but very recently, India signed an agreement with what is called EFTA. EFTA is a group of 4 European countries: Switzerland, Norway, Iceland, and Liechtenstein. Many of you may or may not have heard even of Liechtenstein. Now, this is a bloc which is not a member of the EU, but has a free trading arrangement with the EU. Why is this important? Because in this agreement, for the first time in an agreement, the Swiss side has said that it will bring, largely the Swiss and perhaps the Norwegians, $100 billion of FDI into India in the next 15 years, $50 billion in the next 10 years, and the remaining $50 billion in the next 5 years. Today, the annual investment from FDI inflow, equity inflow from EFTA countries is about $500 million annually. So you can see why I am saying this is that Switzerland today has some of the lead firms in the world in high technology, precision instruments, and many other fields, innovation. Idea is to bring them here, invest, use the size of the Indian market for scaling, because Switzerland is a very small market. They can't scale up. So you use India to scale up, invest here, and then export to the rest of the world. What is this? It is another example of a value chain. A third one, which is perhaps not so used, and strangely enough, this is what are called backward linkages GVC. What does it mean? That I actually import some items I need, largely raw materials or intermediates or capital goods, from any of my trading partners, preferably from those with whom I have an FTA, and they are available to me perhaps at zero duty. I use this, import them, improve my own domestic productiveness and competitiveness, and use it both for the domestic market and for incorporating in exports, and move up the value chain. Now, in the agreements that we had signed in the past, which were largely in the East, as part of our Look East and Act East policy, ASEAN, Japan, Korea, Singapore, Malaysia, all these are manufacturing giants. Now, a large part of our preferential imports from these countries, in fact, as high as about 80%, is made up of raw materials, intermediates, and capital goods. But we have not been able to use this to actually add value and export. So this backward integration GVC so far has not really taken off. But obviously there is now an understanding that this is also one part of the GVC that we can miss only at our own peril. and the ASEAN tigers and all these countries, Korea, Chinese, Taipei, whatever, Taiwan, whatever you name it, all of them have used this route. One last very interesting observation of how the Koreans and the Japanese have mixed their trade and investment with their FTAs. I just said that the Koreans and the Japanese invested heavily in the auto sector in manufacturing facilities, whether it was Hyundai or Honda, etc., etc. Now, the steel which they required for their cars was not the specialty steel. In those days, the domestic production in India of that quality of steel was virtually non-existent. They were being imported largely from Japan, Korea, and others in the region, China, of course, but with a duty. Now, in the FTAs with Japan and Korea, they managed to get a zero duty dispensation for these products. So then they started bringing these products into India at zero duty, making the cars, exporting, adding value and exporting back. Now, this kind of a chain also implies strategic use of not inward FDI but outward foreign direct investment. So, this is something that you can do if, for example, you export raw materials and intermediates to some part of the world. They have to import it from you because they perhaps depend on you to some extent. Then it also makes innate sense to see, particularly if they are a free trade partner or they have a free trade of their own with other partners in the region, to establish investments in those regions, relocate and take advantage of this flow. So this is another kind of GVC that increasingly perhaps will come into play. And finally, as I said, there is no way that you can get into sustainability value chains without being compliant. Today, some of them are compulsory, some of them are private standards, but the day is not very far. Even domestically today, large companies in India are supposed to provide ESG disclosures. So you have accounting norms, you have data collection requirements, and so on. So when they file to RBI or to SEBI, they will have to provide this information. Now, if you want to integrate into value chains, product standards and environmental standards are becoming absolutely critical. Add to this labor standards. The IPH supply chain agreement, for example, talks of these. While it is not saying that you have to change your labor or environmental norms. So whatever labor codes or ILO conventions or multilateral environment agreements that you have actually ratified, you continue to do so, but the race to the bottom, that is reducing or exploiting labor, will not be allowed. That's the reverse side of the coin, which many developing countries would say, hang on, this is my comparative advantage. I have the comparative advantage of labor, and why should I just give it away to you? But there is this dividing line thin perhaps between what is a comparative advantage and perhaps what some might see as an unfair competition. But the point is that if you want to get into these supply chains, you want to get into global value chains, willy-nilly, not today, not tomorrow, maybe in the next 5 years, you will have to embrace some of these norms, maybe not all of them, in ways that are in line with your own development priorities. And India is doing it. On environment and labor, we have some of the best norms in the world. We have ourselves agreed to carbon emission targets when we were not even required to do so. So these are domestic imperatives, but in global supply chains, this is now become imperative. And finally, one last point is that cooperation today is also extending now to the field of technology. And today, not without any reason, you have joint trade and technology forums. Not so long ago, it was regarded that technology is a private shift of technology between commercial interests, and that's the way it should be. But increasingly today, governmental space is getting into technology collaboration agreements. So you have an India-US Trade and Technology Council, an India-EU Trade and Technology Council, and India-Japan Trade and Technology Council. So here, hopefully, the relationship is one more of collaboration, learning, and best practices than simply mercantilist interests. So perhaps just to give you a flavor of how complex the world is, integration into global value chains, given the multiple factors that now determine the issue of where a value chain would be located. As I said, they are no longer economic, they are strategic, they are there. One other final, there is a very important area which you must all know, and that is in the area of critical minerals. Now, the entire energy transition, whether it's the EV revolution, which requires the battery, depends on critical minerals like chromium, cobalt, nickel, etc., etc. And these are largely concentrated in certain parts of the world, many of which are known to be exploiters of child labor and worse in countries which have happened. So this is a paradox, and within this, you now have what is called a critical minerals partnership to do this in a more orderly and systemic manner. Again, India has joined this partnership, which is led by the US. These are indicators of where things are perhaps going to move over the next 1 or 2 decades. So I'll end here, but I do hope I just wanted to perhaps give you a better understanding and a large macro perspective of what all is going on in the world, which shapes the question of global value chains. Thank you.
Thank you so much, sir. I cannot possibly summarize what all sir said, but we learned from how the journey of globalization went from the start of WTO, China's entry, how environmental sustainability has affected the GVCs and led to unilateral measures, as well as how where India stands today as it becomes a part of GVCs and there is a China Plus One strategy, etc. Now I would request the dignitaries to please proceed for the high tea, which is served outside the auditorium. And I would request the students to wait for a while after the dignitaries are gone, and then they can proceed. Thank you.
Yeah, he can do that. That will be better. He can start it now. That will be better. Good.
There's a change of schedule. We'll proceed with Dr. Siddharth Sanyal's address, and then we'll discourse for hiking. I would request Umesh to please introduce Dr. Siddharth.
We are now about to move into one of the highlights, the Indonesia Chapter. We take the privilege of introducing our esteemed keynote speaker, Siddharth Sanyal, Chief Economist and Research. We are extremely sorry for the technical glitch. Mr. Sanyal leads the bank's research efforts covering areas such as macroeconomic trends, financial inclusion, public policy, financial markets, and is responsible for bank's business strategy. He comes with over 21 years of work experience serving as an economist at RBI, Edelweiss Capital, and Barclays Bank. He has been ranked he has been a ranked India economist in multiple occasions as per reputed international surveys. He is an alumni of Jawaharlal Nehru Institute University, and I would request everyone to welcome Mr. Siddharth Sanyal with a round of applause. So the stage is all yours.
You need the laptop? Can I still operate it? Okay, what I'll do, I'll start. I'll look at some of the screens and explain. And if in between you think that it can be done, you let me know. That's not a problem. Thank you very much. I was, when the institute had approached, I was then only I was pretty keen to come here. After coming here and getting to hear, sir, I had the privilege of listening to you a couple of times earlier. This time also it's no exception. Comes with profound knowledge and a very simple exposition of very, very difficult things. Always a very good learning experience. So I'm privileged that I could hear this particular deliberation today. After that, whoever comes, his job becomes in a way bit easier. The tone is set, but at the same time, it's a bit difficult to catch attention or to continue with that kind of intensity. Having said that, I'll just give it a short still, and I'll possibly try to move on to, as Sir had explained, more of a long historical perspective on how things are panning out today in the global value chain, global trade situation. I'll possibly focus a little more on the near term. Near term in the sense how things have moved in the last 4 or 5 years and how things are expected to move on in terms of some of the key economic risks, etc., which might be impacting the global economy as well as the Indian economy. So I had a few slides. I wanted to show it to you, but nevertheless, even if I cannot, I'll possibly try to explain some of the key aspects. The last maybe about 4 or 5 years, more often than not, we have seen some disturbance, some turmoil at a relatively higher than usual frequency in the global economy. Starting, obviously, we all know, in 2020 with the COVID. By the end of the 2020, when the COVID shock seemed to be settling and we were expecting that 2021 will be a year of recovery, we had the COVID second wave globally, which was possibly even worse. By the time 2021 was over and 2022 was there, we were very convinced that this is the year of recovery for the global economy. Do you remember what was there in the month of February in the geopolitical space globally? Are you calling the Ukraine war? Let us call the Russia-Ukraine war. So it was very clearly that Russia-Ukraine conflict, which was something very significant for the global economy, because these two countries are significant supplier of major items, energy-related items, food-related items, very basic food-related items. Things like wheat, things like sunflower oil, and also what is very important is the entire East European as well as Middle East geopolitics can become some kind of a more tricky situation. And more often than not, we started seeing little bit of regional issues more often than not over the course of the last few years. 2023, towards the end of the year, we saw again some heightened geopolitical situation in the Middle East area, which we get to see even now. And in between, we had a spell. So for a while, we were expecting that when in the recovery phase of the global economy, we typically don't see too much of issues like high inflation or things like that. Usually, but this time it was very different. So we saw a situation where growth was recovering only modestly, but still inflation was coming back to the other regions. So as a result, what we had seen in 2022 and 2023, we had seen global central banks increasing interest rates very, very significantly. And that's a big challenge for the financial markets globally. So we have seen quite a few challenges, more often than not, and more frequently than we have seen in the previous years over the course of the last 4 or 5 years. So very clearly, the global backdrop become a lot more challenging, a lot more troubled, what I might say. But very interestingly, there is a hint now that as a global economy, we possibly have coped up better to live in times of uncertainty. I think that it's very, very easy for market analysts or for an economist to talk endlessly the whole day about the risks, the whole day about what has gone wrong, which is very clearly more often than not and it's happening also. But at the same time, if there is some good adjustment on the part of businesses, economies, policymakers, financial markets, and still show resilience in the global economy, I think that's a very, very big message, and we cannot miss it. I'm possibly trying to focus on that. The risks are huge. I cannot ignore that, but at the same time, you should not also ignore the fact that despite all this risk, despite all this turmoil, there are pockets which are doing fantastically well and actually offers tremendous opportunity for future also. I'll just try to explain in terms of a few numbers. Would have been better again if I could show you. I'm going back about 18 months. About 2022 end, 2022 October. The IMF, International Monetary Fund, they on a quarterly basis come out with forecasts about the global economy and various economies. At that time, for 2023, that means about 12 to 15 months forward, they were expecting a growth rate for the US economy at around, just a second. There was a lot of concern about US economy witnessing a couple of quarters of negative growth or technical recession that we call. So in 2022 October or 2023, the IMF, which is IMF, World Bank, they are considered to be in a better position or advantageous position in terms of their understanding and expertise of explaining the global economy and at least the advanced economies. So they were expecting a US growth of 1%. Just 1 year down the line. So not deep into the future. So typically you expect the quality of that prediction there was something strange happening at that point of time. Inflation came back, as I mentioned, came back at a much faster pace than that was expected. And US started hiking interest rates very aggressively. And US hiking interest rates aggressively in their economy is much more powerful and much more potent in terms of cooling down the economy than say, someone like ours, because there the quantum or the share of leverage consumption, leverage investment is much higher than ours. So the situation was getting more and more trickier, more and more adverse. Having said that, now when I look back and see what was the growth rate in the US economy in that particular period in 2023, again I remind you, the forecast was 1% growth. The actual outcome turned out to be 2.5% growth in the US economy. As a whole, the overall advanced economies did better. Japan did better. Eurozone also did better compared to the forecast. Not a great performance, but compared to the forecast. There was a lot of concern about China. China's growth rate also came out better. India's growth rate also came out better. Overall global growth rate in 2023, for 2023, what was projected in October 2023 by none other than IIFT, turned out to be at least 0.5% to, in certain cases, 1 or 1.5%. For example, in case of US, it was 1.5 percentage point higher. Very clearly giving you a hint that even though the situation is getting more and more complex, there is some mechanism businesses, policymakers, economists have devised or have found that they have also learned to live in those times of turmoil. If I try to see, again, if I don't be able to show some charts again, that's a pity. But interestingly, during this time, again, I mentioned about the inflation. There are forecasts again from IIFT and World Bank. When they forecast about the next 2, 3, 4 years about inflation, from 2021 onwards, surprisingly, for every quarter for the next 8 quarters, their inflation forecast kept moving higher and higher. And the central banks actually started tightening or delivered a lot of tightening which the market or the businesses didn't anticipate at that point in time. Now, on the contrary, looks like the inflation momentum, which was there in 2021 and 22, in 2023, that came out a lot softer. Very clearly, it looks like it's moving more towards the long-term average, still higher than the long-term average. But we are coming to a zone in terms of inflationary forces, an area which is relatively better known to us rather than where we were a couple of years back or 18 months back. So as a whole, it looks like in the last 2 years, the global economy survived the shock of central bank tightening, major central bank tightening across the globe, as well as now the inflationary pressures are moving lower. So we see a bit of desired disinflation in the system. And now when we look back, again, if I could show you the charts, the inflation charts look like this, that it shot up during 2 years and now had come down. But if I see the long-term expectation, that what is market's expectation about that particular country's next 10 years inflation, average inflation, that didn't really move much. So looks like the expectation is that this particular shock, whatever has happened, is more temporary, and that say 10-year kind of an average is not, or forecast is not really moving much. What is contributing to that? There are at least 3 to 4 elements you can spot even during this particular phase. One is very clearly technology. So every passing year or every passing day, perhaps, there is a bit of an advancement of technology, which is actually reducing cost of production or moving towards a slightly more efficient mode of production in most segments than what we have been anticipating a few years back. Second is, during the phase of last 6 to 8 years, if not last 10 years, we have seen phases, and people might not be completely aware of that. But in the last, since the global financial crisis in 2008, we have seen some of the unheard of things happening. There was a phase where there was a lot of discussion that there might be something as big as sovereign rating downgrade of the US. And we used to speculate that as and when that happened, that will be a big blow for the financial markets globally and it might actually lead to a lot of turmoil. I don't know what exactly will happen to the US dollar and US interest rates. So we don't know what will be the cascading effect for many of the other economies. Having said that, and having had all this speculation, when it had actually taken place, it was surprising enough, destabilizing enough psychologically and even otherwise for people of my age that we get to see actually get to see a rating downgrade of the US economy and how the global economy will cope up to that. What we have seen, the global economy actually coped up relatively fine. And they actually took a very positive cue from that, positive cue in the sense, it actually pushed them to turn a little more responsible at the economy level as well as at the business level. So as a result, what has happened very clearly over the course of the last 10 to 12 years, and amid a lot of turmoil in the global economy, people have become much more focused about maintaining quality of their balance sheet, focusing on their, reducing their leverage. So more often than not, subsequently, from a rating, so I'm not necessarily talking about sovereign rating, I'm talking about industrial and corporate rating also. More often than not, you get to see or you get to hear from them that they are seeing corporates, etc., becoming a lot more conscious about this particular aspect, and they are becoming a lot more responsible. So leverage on the balance sheet of corporates, which were shooting through the roof at some point of time 15, 18 years back, because that was a time just before the global financial crisis. Everyone was witnessing the interest rates remain low, the central banks pumping a lot of liquidity, you get easy money to put into your business or into your personal consumption, just take it, put it, fill it, shut it, forget it kind of an attitude. And they were actually getting good growth for a period of time. That means if you are borrowing at 5%, you are actually generating a return of 8% or 10% or even higher. So it actually makes sense. But now, when they have witnessed that 8%, 10%, etc., returns are not sustainable for a very long period of time, it very clearly pushed them, as I mentioned, to turn a lot more conservative, lot more responsible, and lot more cautious about future leverage. So as a result, what we have seen that corporates have become less leveraged, even though thus there is a rise in interest rates more than what they had anticipated. The shock, which could have hit them 15 years back, now the impact of that shock or that blow seems to be a lot more manageable. Right. So that possibly added to an additional degree of stability or additional degree of resilience. And that's why when these things come together, technological uptick, cutting down a lot of not so desired expenses, focusing more of efficient channelization of the supply chain. You mentioned, sir, a lot about the supply chain. Very clearly, we have seen over the last few years greater focus about how at every possible way, even though there is a big wave of, I completely agree with you, of deglobalization and putting some of the political issues, etc., in the way. So ideally things could have been a bit better, but at least at a micro level, we see they're very clearly focusing much more on how exactly they can enjoy or ensure a better system. Very clearly, as he explained again in a very detailed way, clear focus on not to put too many eggs in one basket. So as a result, when we see when there is a bit of an escalation, and again, I'm sorry I couldn't show you some of these charts. So in the last 2 years, we have seen that you have some geopolitical crisis or other, almost on a continuous basis, involving the Middle East and some of the other oil exporting countries. Yet, the energy price and global growth has surprised on the higher side. So, in a situation, you would have otherwise expected energy prices and oil prices to shoot through the roof. On the contrary, about 18 months to 24 months back, whatever had been the projection of oil price actually moved lower. That means there is a bit of movement in very clearly in terms of more efficient utilization of energy, apart from trying to rely a little more on some of the alternate sources of energy also. But on that particular front, I think the progress is still at a very, very nascent stage, but hopefully increasingly at a later stage, we'll get to see some support from there also. So as a whole, as a result, what I would like to highlight, long story short, that no doubt about that challenges have become a lot more complex and multidimensional. But for the student community in particular, the message is that it's always very easy for the media community or people like me, the analyst community. It's very easy for me to sensationalize stuff and to say that, look, this risk is coming up, that risk is coming up. It's like a media report, right? Yes, they are coming up, but at the same time, which a lot of us do miss out, and it's not worth missing out, that despite that we have seen economies, businesses, industries are actually doing better. So my key message and earnest request to you, yes, you need to be very cautious, careful, cognizant about the risks. But if you just look at the risk, it's possibly a glass half full, or you are focusing just on the fact that the glass is half empty. But that particular challenge is necessarily giving you some particular opportunity also. I'll try to explain in the next few minutes what exactly I mean by that. So if I look at in terms of there is a parameter called the volatility index in the financial markets. The volatility index shows that whenever there are times of difficulty, typically you see that volatility index move higher. And whenever the volatility index move higher, financial market participants do not really like risk or uncertainty. So typically you see financial markets moving lower. Now try to recall, what have you seen in the financial markets in India and in the global markets of late? What have you seen in Indian markets, the stock market, bond market, currency market? What have you seen? In the global market, what have you seen? So you might be hearing words like the S&P index or the Nasdaq, obviously the Sensex or the Nifty. What have you seen there? But more often than not, we have seen some bit of resilience, some bit of strength there. Now, there someone is putting actual money, not necessarily on sentiment. So very clearly, some bit of opportunity is being observed. There can be a debate whether there is a bit of an exuberance there, whether this is completely justified or rational, but at the same time, some bit of opportunity you can actually spot, because ultimately at the end of the day, you are analyzing the hard numbers of corporate earnings. Nobody is investing in a financial market just thinking, oh, I'll be a $5 trillion economy, I'll be big in the global economy, okay, let me put so much money here. When I put my money there, eventually what do I see? That, okay, this particular corporate, what is its earning potential or earning estimate for this year, next 3 years, next 5 years? Okay, this particular, his earning is actually moving, or its earning is moving at this rate. Okay, that means its price earning ratio might actually move higher a bit. It's worth investing here, because at this moment, the price earning ratio, what it's reflecting today is lower than its average or around the average. It might actually move higher. So we are constantly seeing this particular aspect. The volatility index, I'll just give you one or two some very basic idea what we can discuss here. Higher the volatility index, that is higher volatility, not so positive for the market. Now at the time of whatever I can read from the chart in front of me, at the time of the Lehman crisis or 2008 global financial market crisis, we had a volatility index reading shooting up to close to 60. there is no limit as such. That it need not necessarily be between 0 to 100 or between 50 to 100 or 0, nothing like that. It can go to any level. Now think about it. I'll give you a few crises in the past. Think about what can be, maybe you people were not really actively involved in markets in case of some of the crises, you people were not even born. But think about it, that what was the dimension of the crisis? And if I tell you a value of the volatility index, where could it go in the next few times? So for example, there was a time when there was a dot-com bubble, or there was a transition into there was a term called Y2K, you may or may not really be completely aware. So there was a kind of a concern that when it will come, that might actually put a lot of systems globally into a lot of difficulty, because the global IT systems, public digital infrastructure, all these things were relatively nascent. And I'm just reading from the chart in front of me. At that point of time, the global volatility index had hit something like 40. At the time of 2003, when there was again a bit of uncertainty in the global economy, it was again around 35-40. At the time of Lehman crisis, please try to listen to these numbers carefully, because I'll ask you what is your guess. At the time of the Lehman crisis, it was a major crisis by that time compared to the previous one, the global financial crisis. It hit something like 60. So basically, we see that when the intensity of the crisis go higher, the volatility index will go higher. But then came another about 10, 12 years time, then came COVID, mother of all crises possibly, much, much bigger than all these crises possibly put together. And if in the case of the global financial crisis, the volatility index is something like 60, anybody guess what could have been the level of that index at the time of COVID? Roughly. Any guess? Someone said 100 here. Any other guess? 500. Okay. Anything? Louder. 95. Okay. More precise. Incidentally, we have seen a reading somewhere in the vicinity of 50. Not even hitting, that was just a guess. So let me not celebrate that much. Okay, now, and there is no chocolate, so it would have been better that way. But jokes apart, the message is that at the possibly when what we discussed earlier, during 2003 to 2008, at the time of global financial crisis or the subprime crisis, etc., a big difference was people in general, assumption-wise, lot more bullish, lot more bearish. So when a crisis hit them, possibly the volatility they could absorb was a lot less. That's why the volatility index shot up a lot more. Now, who were leveraged? Everyone. When we mean by everyone, who is that everyone? Corporates were more leveraged. As an individual, in terms of my house purchase, I was more leveraged. In terms of my investment in the stock market, I was leveraged. As a nation, I was leveraged. Compared to that, the big difference is that after the US rating downgrade and after a lot of hardship over the course of the next 10 years or so, difficult times taught us, all global citizens, the value of being cautious, the value of being a little more conservative. Global economy and most economies, most corporates, most individuals are a lot less leveraged to start with. Then there was the tailwind also from the technology side, which has progressed significantly over the course of the last 10 years. And also a bit of focus in terms of more efficient utilization of all resources, etc., despite the globalization. Without the globalization, it possibly could have been a lot better. So as a result, we have seen a volatility index which is lower at the time of the COVID shock, which is possibly 10x or 20x or 100x bigger than any other shock. Still, we saw a volatility index which is lower. Subsequently, at times of the Russia-Ukraine war or at the time of Israel Israel and all these conflicts at the moment also, none of the occasions we have seen the volatility index coming even closer. So basically, with our conservatism and focus on improving efficiency at my end, it's very clearly the global economy is in a position or on a stronger footing to absorb shocks a little better. It's always a lot better if you have monetary and fiscal tailwind behind you. That if the government starts spending a lot more, or if the central bank gives you a lot more liquidity, or you get a lot lower rate, it's always nice. But you need to see whether these aspects are sustainable. I think on the sustainability factor, there is a lot of questions and a lot of caution and a lot of carefulness is coming in part of the people who were expecting it, demanding it, as people who were supplying it. Again, I try to share some of the charts, etc., for your benefit to the organizers. But if I see that of late, what we have seen, that there is a bit of uptick in, or rather, quite a bit of uptick in central banks' rates and all. So central banks are tightening things very clearly compared to someone of your age. If you look back, possibly you have not seen this kind of central bank tightening in the past. But if we go back into history, if we see 20 years, 25 years, this kind of hikes there have been instances of much higher hikes. If I go back for 40 years, there were hikes which are much so compared, again, just to give you a bit of a sense, if I just read out some of the numbers. Okay, interest rates, sorry for this, from about 0% in case of, for example, the Eurozone, so for example, the US, 0%, close to zero in 2020. The rates are in the north of 5%, so 5 percentage point hike. Big shock. But if I go back deep into history, I can see so policy rates, and I'm just reading about, it's not US, I don't have the US interest rate per se, but the overall advanced economies interest rates, which are today on an average, a few advanced economies put together, weighted average is around 4.5%. In the 1980s, at the time of something called the oil price shock, this particular number used to be around 13%. So even after all this big shock now, you are actually seeing a shock which is 1/3 of what earlier people have seen. Also, if I talk about the size of the central bank balance sheet, the central bank balance sheet has possibly expanded by 2x, 3x, 5x, in some cases 10x, also over the course of the last 1 or 2 decades. So why I'm deliberating a lot on this? Basically, I'm trying to say that even though the US or advanced economies have hiked their interest rate, a lot of clatter and debate and demand that it should now come down tomorrow, they should start cutting, day after tomorrow they should deliver 3 more cuts. But the reality is that this is at a level which is not so astonishingly high. And we have seen phases of much higher interest rates and much lower liquidity support from the global central banks in the past. So as a business, as a nation, as policymakers, if someone needs to be successful and on a strong footing, possibly the lesson is that not to rely on a lot of monetary support going ahead. Most probably central banks will more often than not remain a lot more conservative. And it will be that set of people who will be more successful, people who are a lot more conservative and have actually put focus in terms of their strength rather than relying on the fact that a high tide will be lifting the boat. On the other hand, the other part, we mentioned about the monetary policy side. Yeah, around 5-7 minutes. We discussed about the monetary policy side, and very difficult to expect a lot of easing anytime soon, as we discussed. Interestingly, on the fiscal policy side, that's the other tool or other brute force that can also give a lot of support to economies. What is happening on that particular front? Interestingly, we get to see that if I look at two things together, one is fiscal deficit of all nations put together and public debt across countries, what we get to see that on these two, we are more often than not at a level which are highest not only in the last 30, 40 years, in some of the cases, it's highest in the last 100 years. These are not absolute pointers, I'm talking about percentage of GDP, etc. So normalized to that extent. Now we are having a lot of nations, a lot of countries whose public debt and whose fiscal deficit is highest in, it's very important, 100 years. Why 100 years is so important? In 100 years, apart from everything else, this period covers two world wars. The World War I and World War II. The world was a lot more simple at that point of time. The only thing governments could do to support economies or to sustain in the world to spend endlessly, incur a lot of inflation, still incur a lot of public debt and give a lot of money and continue to expand their fiscal deficit just to survive the war and to go ahead in the post-war reconstruction time. Having said that, we are witnessing a time, we are today standing at a juncture where there are a lot of countries where the fiscal deficit and public debt is the highest in the last 100 years. Again, what is the key takeaway then? Then further scope of them increasing it, incurring more fiscal deficit or incurring more public debt is very, very limited, to put it mildly. Or if at all, they will possibly be trying to cut it down over a period of time. So as a whole, we see that while there is a lot of clutter and a lot of demand that tomorrow central bank should start cutting endlessly and government should support in so many areas, I think the hands are tied for most of this public policy forces. So basically, you are in a strong footing if you have tied your value chain well, if you have actually kept some headroom with you in terms of providing support help at the time of need. Maybe the last 5 minutes it's incomplete if I don't touch upon India in particular. And I tend to compliment the Indian policymakers here. If you see, at the time of COVID, when there have been large central banks which have been cutting very aggressively, providing a lot of fiscal support, incurring a lot of debt, if you see, looking back, you get to see that India's policy making or India's policy changes are not more nuanced, not more vulnerable. We cut interest rates slightly, that's why when there was a time to hike, we hiked relatively less. So now it might be very interesting for financial markets to aggressively cut and aggressively hike in quick succession. But if you think about a good driver and a not so good driver on the road, he doesn't move the steering every now and then like this, right? A good driver possibly holds it a lot more steady. Right? I think that's the difference. So that's the difference. In case if you see a policymaker or a policy-making body who could actually navigate through difficult times with relatively less jobs, that means you are actually offering a situation where public policy is more stable, the policy environment is more stable. So as a business, I can think of my business and plan for my business better. So I think we are getting that particular advantage, and that's why it's not a big surprise that Indian firms more often than not are doing well. We have been very conservative. So looking back, again, as I'm not being able to show you some of the charts, etc., I'm telling the story in a slightly more generic fashion. So if you look back, what have been the strength of Indian economy and what have been the typical worries of Indian economy, more often than not, in the past 20, 30 years. Typically, we were seeing that post-liberalization growth had been our strength, that more often than not, we had a strong period of growth. But at the same time, our three big worries were what? Three big worries were either high inflation, or high current account deficit, or external deficit and high fiscal deficit. You are mostly students of economics, right? Yeah? Or management, right? Mostly students, no, all students. I'm free to use this terms. So you had good growth, which had always been a positive for India, but you more often than not, many a times you had high inflation, high current account deficit, and high fiscal deficit. Comparatively, in the recent past, you get to see, even if in some cases growth numbers, etc., have not been to our complete satisfaction, more often than not, compared to what used to be the inflation numbers say 20 years back, compared to that, you are at an inflation zone which is much better. So today, we get very upset if inflation from 5% moves to 6%, we think what will be the action, etc. So again, it's possibly beyond your memory. But if you look back, go back and check some of the numbers, 20 years back, many times you had seen the CPI inflation in the zone of 12%, 15%. The interest rate, which is a housing loan interest rate, which is in the vicinity of 8-9%. Many times we ourselves have gone for loans at the rate of 15% and 16% because inflation used to be high. Why government bond interest rate used to be high? Because fiscal deficit used to be much higher. There had been phases where the central government fiscal deficit used to be 9%, 10% compared to today's 4-5%. And the debate today is more like this year it will be 4.5% or 4.8%. That means you have come to a zone which is relatively narrow, relatively stable, and somewhere, same with the current account deficit. It depends a lot on the global forces, but today, this year's forecast, for example, is somewhere in the vicinity of say 1.5%. If you are very lucky, you might get 1%. If you are not so lucky, you might get 2%. But the big message is that they are coming to a zone which is slightly a lot more healthy, more converging a lot better with the global numbers. That's why, as a whole, it's not completely unrealistic to expect a pretty strong, good future for the economy as a whole. When I say economy as a whole, does it mean for everyone and every business and every individual in this particular economy? Unfortunately, I cannot say that. Globally today, possibly inequality is a huge challenge. And in case of a relatively low income country, we are not really low income, but a relatively low income country with relatively lower social security nets, etc. The inequality issue is possibly a slightly more challenging. We have to figure out how exactly we take care of that. We have to figure out how exactly the infrastructure which we are creating across the country start benefiting a lot more in the rural economy also, so that there is not a lot of unforced or unwilling migration to other countries or to other cities, etc., etc. So I'm not trying to paint a picture which is too rosy and which is saying that it will be hunky-dory for everyone, for every economic entity, very easy for policymakers. Absolutely not. But the broad contours of economic parameters, the pillars, they seem to be a lot better in place. Inflation seems to be very better controlled. Fiscal deficit, current account deficit. As a result, the volatility in currencies you are seeing is a lot better or a lot less. The pressure on interest rate is relatively less. So as a whole, it actually paves the way for a relatively more sustainable and more egalitarian. I will not say really. I'm not too sure about that as of now. But it actually helps you to be slightly more positive and optimistic about growth prospects going ahead. Very clearly, as I mentioned, we need to take care of the inequality issue a lot more. We need to take into account the fact that we actually extend the benefits of infrastructure creation across the country into the rural parts also. That possibly makes a big difference in terms of the inequality part. Also, so some areas like we always, whenever these discussions come up, we do always talk about health, education, etc. Education is, and especially in an institution like this, what do you think? What is the standard of education for India? What do you think? Any quick guess? It's anybody's guess. Come on. Is it good? Bad? Very low? Okay. In general, you were saying that very low compared to global benchmarks. Okay. Let me try to nudge you a bit and try to give you one particular way of thinking, and you tell me whether you agree. I'm not an expert in education, but just thinking loudly perhaps, it feels like the standard of higher education in India is actually very good. So some of the institutes are there, possibly your institution is also not an exception, which possibly comes in the range of very, very reputed, very, very strong institutions, more often than not at a very affordable price, more often than not. Think about it. Will you be able to say exactly the same thing when you talk about lower level and primary education? Possibly there you have a system where if you can pay a high price, very high quality of education is available. But if you cannot pay a very high price, you may or may not actually get that high quality of education. Oh, if you agree this is the situation in India, let us think of what is the situation, for example, in say a developed country like US. There, think about the lower level of primary education. Irrespective of you have money or not, you have access to a pretty decent school in the vicinity, not the international school, but the local municipal school. A lot of kids go in that vicinity, and that's actually pretty high quality at very negligible price. The prices go sky high when you talk about higher education, right? So the difference here, which we are creating, is we are not very sure whether we are giving the best opportunity or most egalitarian opportunity to a kid at the initial stage, which that particular country is being able to give. Possibly we have to focus a little more there. When we are fighting a situation of greater inequality or trying to strive towards greater equality, a very important factor is to equip a student or a young kid with the benefit or the already of education or the basic education. I'm sure some of these things will come. It's no joke. The way India has actually plugged in some of the soft infrastructure parts also, maybe in the last 20 years. So ask one of your elder cousins or your previous generation, what used to be our expectation when the India team used to go for the Asian Games or for the Olympics? And what is your expectation today? These are very soft aspects. But when a country grows, when a country prospers, eventually we become able to put in money, effort, bandwidth, all these things to focus on these areas, and we show its benefit over a period of time. I'm sure some of these areas with our continued prosperity will be able to plug in some of the holes in some of these areas also, education, health also. And if instead of me standing here and delivering this 45-minute lecture today, some of you, when you will be standing here in 2040, perhaps you will be telling a much more positive story to the future generation. I'll stop with that particular hope and optimism, and for your patience.
Thank you for this incredible session. Sir has incredibly delineated the impact of Russia-Ukraine wars in the Middle East and explained how increasing interest rates by the global central banks is a cause of concern, how IMF and World Bank's expected US growth of 1% differed from the actual outcome, how the inflation momentum has become softer in 2023 than 2021 and 2022. He has also shared his policy perspective with respect to India and quality of education in India. Thank you, sir, for this interactive discussion. Now, following Mr. Sanyal's engaging talk, we have two exciting events lined up for you all: policy debate and quiz. Before that, we have a high tea right outside the auditorium for the students. After high tea, we have the next phase of our event. Participants, please make your way to classroom 10 for debate and classroom 9 for quiz sessions. Let's continue this afternoon of learning and engagement. Thank you.
Because we had one week to so I think perhaps that shock was yes, thank you. So continue for it.
আমি সেটাই ভাবছিলাম যে তুমি হঠাৎ অনেকটা শেষ হয়ে গেল না টেরিয়ার এখনো উনি আমাদের সঙ্গে আরে ও তো ছিল আমি জানি না আমি জানলাম কি করেছিল কেউ পাঠিয়ে ওরা ছিল মানে কি করে আমার কথা হচ্ছে আপনি তো বলেছি অনেকদিন বাইরে আমি একটা কথা ভাবলে হচ্ছে ওই একটা চান্স পাবে ও খুব উৎসাহী তুমি তো করে যাচ্ছি ছেলে ভালো আছে হ্যাঁ আপনি ছেলে চলে গেছে
Good afternoon, one and all present here. We will be starting shortly, so we request you for all your friends if they are waiting outside, and we request everyone to be seated. Those who are coming back from lunch, I request you to be seated very quickly. Thank you for your cooperation. Welcome back to IIFT Annual Economics Conclave 2024. I hope you all have had a great morning with all our events that were happening. Right now, we are back again with an exciting event of the day, the panel discussion. In the present scenario, where almost every corner of the world is deeply connected to another, building global value chain facilitates creating networks among firms in different countries to produce goods or services. Today in the morning, the address by our chief guest, Mr. Shuman Chaudhary, and our keynote address by Mr. Siddharth Shangal made us aware of the development of global value chains and how the risks to global markets have increased in the frequency in the recent past. In the light of this knowledge, we will now delve into exactly how India's integration with the global value chain can be improved and how we can attain the path of net carbon neutrality by 2070 so that our futures are one of sustainable growth and economic prosperity. It gives me great pleasure to announce our theme for the panel discussion, Building Global Value Chains, Trade Policy and Climate Finance Strategies in India. Our esteemed panelists today are a wonderful mix of perspectives from academia, corporate, and multilateral organizations. I would request them to come on stage one by one. Today, we have with us Professor Roger Acharya from Jadavpur University. He is a stalwart academic voice in international trade, trade policy, and economic development. He has decades of experience in teaching students of economics, and he has prepared a very informative presentation for us today. I now call upon Michi to felicitate Professor Roger Acharya on the stage. Welcome, sir.
So you have to wait.
We would also request our other panelists to subsequently join us on the stage so that we can have a group picture. So next, I will call upon Mr. Ambarish Dasgupta, the founder of Intuit Consulting. Mr. Dasgupta works extensively in global value chains. As the former president of Bengal Chamber of Commerce and Industry, he has a keen perspective of the trends of our local economy, which I'm sure he will be explaining to us in depth today. I now call upon Noyamika to facilitate Mr. Dasgupta.
Thank you.
Welcome, Mr. Dasgupta. On the opposite end of the panel, we have Mr. Joydeep Mukherjee, co-founder of Snappy Cats, a pioneering electric vehicle cab startup that is paving the way for cleaner transportation. As a startup founder, he has a unique outlook on being a part of the value chain and the current climate of sustainable tech. I now call upon Ankita to facilitate Mr. Joydeep Mukherjee. Welcome, sir. By his side is Mr. Ajay Bandyopadhyay from International Finance Corporation of the World Bank. Mr. Bandyopadhyay leads the Climate Advisory for South Asia, focusing on expanding the climate investment pipeline by enabling investments in low carbon and circular businesses. He also has a special connection with IIFT. He is our very dear alumni. I now call upon Lehe to please facilitate Mr. Ajay Bandyopadhyay. Welcome back once again, sir. I hope you like the campus. Yes, sir. Finally, amidst them, we have our very own Professor Vivek Roy Chaudhary, who will be moderating the panel. I call upon our classmate Shreya to facilitate Vivek, sir. Thank you, sir. We request the audience to look forward to an enlightening discussion, and we will be taking a few audience questions at the end.
Okay, so normally, after the lunch is quite difficult. No, can't hear.
Something is wrong with my
Hello. Hello, now it's okay? Yes, fine. Okay, so already the introduction round is over, and so the topic for today's discussion is quite, I think, important. And I was just looking up because I was given the task of moderating a session on which I almost don't have any knowledge. So I was just looking up some papers, and I was seeing, of course, there are many papers which have already taken up this issue, and how climate financing and GVC are related. There are quite a few papers. Okay. And so one thing that is coming up is that on the one hand, if you look at India's GVC participation, we have done some work. Some of my PhD students also have done, and they are seeing it's quite low when we compare that with similarly placed or similarly developed economies, quite less compared to that. And we need to all recommendations are that we need to scale that up, and we need to integrate with that value chain, and also how climate risk financing is actually related to the GVCs. That is a very, very important issue in the sense that if you look at the production process, then if we are actually using technologies which are, I think, more clean, they are also more costly. So that is again kind of a trade-off. So in economics, we always speak about trade-offs. So there are trade-offs. And on the other hand, if you look at how the I would say environmental sensitivity of the goods that are produced in developing countries, we have pollution haven hypothesis and other kind of. So that's already there. So now the problem is that the data shows that maybe the developing countries are more polluting, but I think some responsibility for that is also lying with the developers. So these are some few words that I thought maybe just starting the discussion. So what kind of so I am the meeting and all the experts around me. So now what we are going to do is that we are going to start with the small, I think, speech by each of them. So maybe 10-12 minutes. Each of them can give their perspectives on this very important issue, and then after that we open it for questions, and maybe some more discussions will flow after each of them have spoken and we have discussed about these very important issues. So I think we will start with Professor Acharya. So yeah,
I have some PPT, so
you can go there.
Yeah. Working. Yeah. Okay. Okay. So when the students emailed me, I was wondering whether I at all know anything about climate financing, and then I discovered that I don't know financing. Neither do I. Neither am I as expert on climate change. But of course, I know a little bit of GVC and FRED, so I focus on that. And as Vivek, who has another, we have a connection. He is not only junior in my academic discipline, but he is also my brother-in-law. Okay. But that apart, what Vivek has said that is encouraging me. If India's participation in GVC is so low, then why should we bother about climate finance? But that is not the excuse that I will be giving. So let me start with a few basic things that I will be sharing with you. That is what is GVC. We all know about that now it is not a single good. Most of the manufacturing goods. I will be drawing upon a distinction between the manufacturing and the services, GVC. But most of the manufacturing goods that we see around us or use are not produced in only one country. It's basically what we say when we talk about total value chain. We also talk about fragmentation of the vertical stages of production. And we will see that there are lots of role that ICT has been playing in such fragmentation, which is making possible the GBC thread. Anyway, so, and what GBC has done, GBC has got a lot of trade in intermediate goods. The most important, I will share with you one particular data, that the nature of transformation of one intermediate good into the final good. That transformation rate was 7.9 on the average during 2000, which went up to 8.5 during 2019. So the number of steps on the average. So that can explain what sort of intermediate goods trade that is taking place all over the world. Because whenever we talk about GBC, it's basically fragmenting vertical stages and spreading out different stages in different countries. Now, a single finished product nowadays are strong that as I was talking about. So let me just skip this. I've already talked about two types of GBC participation we know about, which is the backward GBC and the forward GBC. Okay, so what is the backward GBC? Very quickly, going to the definition. So backward GBC participation is the one where a country's exports embody value added to the intermediate good that we have imported. On the other hand, the forward GBC is just the other thing that you are exporting the intermediate goods, which is not fully absorbed in the importing country. Then the importing country adds value to that and exports to the third country. So that's the forward GBC. Okay. And there are examples talking about that. My second example. Now let me very briefly talk about the drivers of GBC participation, because that is important to know. Because whenever we talk about any policies, we need to know the fundamentals. So if you look at the fundamentals, what is this? It's the vertical specialization, right? In the first course of your international trade theory, you have learned about what I say horizontal specialization. What is that? It's a kind of Italian specialization. So sectors and countries are specializing in finished products, which are produced under one factory shed. And there, the notion of Italian comparative advantage, which stems from technological asymmetry, factoring down differences, and so on. So, same principle underlies the vertical specialization, where countries specialize according to their comparative advantage in different stages. And very few people, they don't refer to very few early works by Orlando Channel in 1993, Economica, Global Market, again, Economica 1997, Fins for Hansen. They start with the 2000 papers, but they are complete oblivion of what the predecessors had done. And of course, the Fins for Hansen in 1996. So there, how the Italian comparative advantage, and they didn't talk explicitly about GBC, but they talked about vertical specialization. They talked about how the intermediate goods trade can take place. Okay. So let us not forget about our predecessors. And then, but we also, first of all, we talk about fragmentation of the production process, but there is also a development stage. Okay, so a product development stage, which starts with R&D, design, blueprints, successful innovation. All these are the zero stage, which are typically organized in the developed countries, which have the skill manpower, which have the technological capabilities, and which also invest a lot in R&D. It's a huge percentage of their GDP in R&D. So they have the competitive advantage. You will rarely find that product development stage is taking place in a developing country, because there will be some exceptions I will be talking about. So after the product development stage, then different stages of production is spread across countries, again according to their competitive advantages. Usually in the production stage, the low stages are relatively less skill labor intensive, relatively less capital intensive. So they are usually concentrated in the developing countries. And as we go up the ladder, we see developed countries are coming in. Again, there will be some exceptions to this hierarchy or the ladder I'll be talking about. Of course, India is no exception. Even hard that India is the largest producer of vaccines. But most of those vaccines are innovated and developed in the developed countries. So that's my development stage. Even the AstraZeneca, the Covishield, that's the AstraZeneca, right? That was not innovated here, but the Serum Institute produced in bulk. So when we talk about China, about the factory of the world, India is known as the pharmacy of the third world. Okay? Because we are the largest producers of generic drugs as well, selling millions of, which no other country in the world can match. Very interesting. Where from did we have or did we gain that kind of competitive advantage? We don't know. But anyway, so that's the exception that people talk about in the hierarchy. Okay. Now, as I was saying, I will talk about three countries which have somehow is a person in this hierarchy. One is, as I have talked about, India in pharmaceuticals, etc. So another two things where India is very good at. One is, of course, the airspace. We are providing aerospace service to many European countries as well. And of course, the IT and services. Okay. And China is well known that from very low quality, low technology intensive to high technology intensive goods that they can produce. And they have the capability of producing goods in large scale. So that's the factory of the world level has been given to China. Vietnam and a small country. They are upcoming technological giants in electronics and semiconductors, 5G. So maybe Vietnam doesn't have the capacity of producing it as large as China can, but still they are becoming very fast, becoming the technology leaders. So there are countries, so-called developing countries, which do not fall in that kind of hierarchy that I was talking about. But still, those are the exceptions. Okay, so now what are the salient features of GVCs? Very quickly, if we go through, mainly the GVCs are concentrated in machinery and electronics, as far as the goods are concerned, and in regions which produce them. East Asia, North America, Western Europe. Most of the things that I'll be talking about is based on the global value chain report of the World Bank and the World Development Report 2020 and 2021. So these are not my invention. I'm just reporting this. Some service production, of course, some service productions are also in the GVC. One particular example that we talk about, where India is very good at, is the software development. And particularly between the countries which are located in two geographically separated time zones, like India and the United States. And that is kind of virtual trade. So that kind of GVC trade is also there, but predominantly GVC is physical in nature. Okay? So basically, most of the GVC is physical in nature. Most importantly, many of the global value chains are not even global, they are regional. There are three hubs actually: East Asia, Europe, and North America. Where East Asia and Europe are regional, they are not global, they are GVCs. Whereas the North America, that is the more global GCC that we talk about. Global in the sense they go beyond our region to sell and buy intermediate inputs. Okay, so basically, and why this has been happening? Because geography or location and the transport network, etc., play a big role. Let me give you one example. Proximity to the hubs in the global trade network. 4 global trade networks are there in the world: China, Germany, Japan, and the United States. And the countries which are in proximity of these global hubs, they are better aligned with the GBC trend. That has been observed. So geography and location does play a role. Vietnam's proximity with regional suppliers of electronic inputs such as China, Japan, Korea, and Singapore clearly helped its GBC participation. So again, the proximity. And in that context, the transport infrastructure, logistic costs, these are becoming very important. In fact, one of the major impediments of countries for participating in GBC is the transport cost. Most importantly, the transport network. Take one example. Countries in Central Asia, while they are central in the distance to their neighbors, the problem is they are still isolated because they have very poor transport infrastructure. So main transport corridor is very poorly developed. So it is not just the geographical distance we talk about, but important is the transport infrastructure. That is the most important thing. And particularly this is important for the landlocked countries, because landlocked countries will have very limited option participating in GBC unless they can really develop their road transport infrastructure. Okay, so high logistic costs also prohibit landlocked countries. So most of the sub-Saharan African countries are landlocked, and there the logistic cost is very high. Okay, so role of IC. You see, when we fragment the production process and look at different stages in different countries, you need to coordinate among different production blocks. And ICT and the advent of information technology has made it possible. Because before 1990, even mid-80s, we didn't even think about or imagine about fragmenting the production stages and locating in different countries, because coordination cost was very high. But there is a very nice little piece by Jones and Kiyosaki in 1990, where they had shown that how the CLS technology for different fragments can actually lead to GBC, can lead to economies of scale. So that is because you see, when the producer will think about fragmenting and locating in different countries, for example, a multinational corporation, what matters for such a multinational corporation to fragment in different countries and outsource is the profitability. And one of the key components of profitability is, of course, if you can attain the economies of scale. Okay. There's a nice paper because even with CRS, there are fixed costs. So CRS with fixed costs will give you economies of scale. That's a piece of study which is going beyond, it's not in the scope of my lecture today. So telecommunication and financial services facilitate and coordinate the geographic dispersion of production in all sectors. Okay, let me go back to, then very quickly, let me come back to the talking about, but that's the most important point for India, for example. When we talk about backward GBC, participation in the backward GBC, because what is happening? So for the earlier stage, you were importing intermediate inputs, and then you were adding value and exporting. If your input tariff is very high, then that GBC is not feasible. Okay. So tariff does play a role. Take one example. China's accession to the WTO in 2001 and the accompanying requirement to reduce more than 7,000 lines of tariff, it helped China and its trade partners to increase their GDP participation. So that, because while we are talking about China, in many empirical work, often you encounter what is called China effect. And sometimes across country panel declarations, they include China, and some results are reported without China, because the size effect of China is so huge. So people think about what would have happened if we had not China in our sample. So that's why, and this is one example what the China factor can do. Okay. Now, okay, there is one study which I'm not reporting, but let me go back to another thing. Brazil. Brazil has one of the very largest automotive sector. In 2016, it employed 500,000 workers. But they have one policy, industrial policy, which requires high local content, local production content. Okay, what does it mean? That means in order to produce a car, you have to use a certain percentage of intermediate goods locally produced, and which is called, they have a specific policy name, Innover Auto Policy. That was during 2017, and that prevented their participation in the backward use. That is one example. Now we talk about a lot of Atmanirbhar Bharat or self-reliant India.
You have 2 minutes.
Yeah, sure. Atmanirbhar Bharat or self-reliant India. What does it do? It also talks about local production, encouraging local production of intermediate goods, dependence on our own indigenous producers. But that will, so how can this fit to GDP participation? Do we have any comparative advantage or cost advantage in intermediate inputs? No. Most of the cases, no. So what will happen? If we bring the requirement of local contents, then we can encounter the similar problem that Brazil may have. The question is, well, can we participate in the forward GDP? Unlikely again. Because what is the forward GDP? We will export the intermediate inputs, which the other countries will use for their export production. Why is this unlikely? Because we don't have any competitive advantage. So how to push that? One might say, well, then you have to encourage them to use and attain the economies of scale under the temporary trade protection. But that was the old policy, and it didn't deliver, right? It destroyed trade protection, destroyed innovation possibilities. I take a pinch of salt when I teach students. We know about his master's time, we know about his master's voice, add to that his master's car and his master's airline. I don't have to explain what is his master car and his master airline. HMT has shut down its business as well. Anyway, so what can be done? One way is the free trade agreements. Of course, free trade agreement can work because if you have an FTA partner, then you are slashing tariff, but only with respect to one trading partner or two trading partners. So still, your import competing industry, input producing industry, may not be facing as intense competition as it would have arisen if you had unilateral tariff reduction. So FTA might work. Well, it did work for the European Union countries. European Union was critical in bringing Czech Republic, Hungary, Poland, and Slovak Republic, and later Bulgaria and Romania into GDPs. It did work. Where do we stand? Well, very little FTAs we have, effective FTAs. FTA with Russia we have, Japan, it is almost insignificant. We have in South Korea, Singapore. The only thing is Australia. That's a big one. Except for that, we don't have anything. We don't have any FTA with EU because of the argument and disagreement over labor standards, as well as environmental standards and chips, generic production of generic drugs. Okay, and we don't have any FTA with USA because USA also stipulates some conditions. They have an open invitation that if any country fulfills these three criteria, we will sign the FTA. We didn't. So where do we stand, that we will have to really think about. Let me stop here and we can carry on later on. Thank you very much.
Okay, thanks to Professor Acharya for a very, I think, deep, presentation on the GBCs and how it can, build the future and why for India it didn't happen and why for some countries it is actually working. So next we will, invite Mr. Ambaris Dasgupta for a speech.
Good afternoon, students, professors, and other respectable dignitaries who are here. It's indeed a pleasure. I'm honored also to be here, but I really do not know how long this feeling of honor will persist with me. Because, as a management consultant throughout in my life, I think we are a birthright to come to the stage and speak on anything that you don't know. So, in fact, I'm defining one of the statements or one of the advices that Mark Twain once gave. He said that if you do not know a subject, then you will later stay quiet because people may think you are a fool, but then why open your mouth to corroborate that? So I'm possibly defining that piece of advice. But I compliment IIFT really for choosing such a topic, which is trade policy and climate financing in India. But conveniently, disregarding the in India part, maybe because of the model code of conduct of course, so we will not be touching upon for the in India, but the trade financing and the trade policy and climate financing. Now, these two words definitely can be considered as two different subjects. They have their own nuances, they have their own imperatives, they have their own issues, challenges. It's separated with the conjunction and that gives us an opportunity now, or that it creates a kind of an expectation that we will talk about the intersection of the two. And therefore, I will try to speak more on the intersection of the two and not so much on each one of these subjects as such. But again, I'm saying that this is not a very deterministic kind of a subject that on which a lot of theories or on which a lot of practical decisions or practical steps have already been in place so that I could get into a little bit of an informative one, but it can be more like a brainstorming ideation because it's nothing really, really deterministic in this matter. Now, before we move into the trade policy and the intersection of this with the climate financing, let's try to also understand that what are the negative or the global externalities of the trade situation today. The trade situation is definitely not as it was previously, possibly way back, when I will be basically doing the trading where I get the best buy. I get a good product and I get the good price. The trade situation now has to consider multiple aspects, of which the geopolitical issue is definitely being well spoken of. Who is destroying or who is having which country is being considered to be a threat to my hegemony, my religious beliefs, individual egos, the economic situation of the country, the social unrest, the security aspects, multiple factors that do come in determining that what kind of trade relationship we will be treating with another country or with a corporate in a country. You all possibly will be quite expert on the fiscal, ESP, or the fiscal, the high students. So the last key, the environment, is the fifth one of the six. How much will it really be able to jostle up and take a position, teaching the other five in determining the trade rules and policies is a question that we really do not have an answer. Even IMF now sees the specter of a Cold War fragmenting the world into multiple blocks and therefore hugely inhibiting the free movement of the goods. Whereas when the World Bank has definitely proclaimed long back the global value chain, the theories and why how the global value chains can really help the economy globally as well as in the country. World Economic Forum in 2024, as recent as 2024 in Davos that was concluded, they always do this. Every year they publish this report. In the report that they have been there, you should be reading that. It's really available. The Global Risk Report, they've identified 34 risks for the next 2 years and for the next 10 years also. The positions change for the 34 risks. But what I'm trying to say is not that report, but there is a Global Cooperation Barometer report that is also being published. If you read that report, you will see now how the global cooperation indices are coming down and the threat to the global cooperation indices for the next 10 years. So it's again and again is we showing that the trade situation itself may possibly be very fragmented, may move from a globalization to a regionalization. Even if that is not, then there could be many other factors which will be determining the trade policy. In fact, the World Economic Forum report also suggests a market concentrator who will be doing what, since we are not actually in a very hypothetical situation of having a very fair and equitable distribution of skills and all important goods, the rare earths, metals, minerals, fossil fuels all around the world. So the market concentrators could also be determining the political alliances, or the political alliances could also be formed because of the market concentrators. Who owns what? Who owns lithium? And therefore, how powerful in the global value chain they become. That will also, to a large extent, determine the trade policies. Now, again, therefore, we don't know how much in this situation, sometimes the world economy is offering, sometimes the world politics really coming down to the crumbles. But we all know the wars, the Ukraine war, which has now become actually quite old and well discussed. Even the Israel-Palestine or the Gaza also is now quite well discussed. The Israel-Iran, even as late as 48 hours back, Israel has announced that there will be still pounding bombs on the Rafah, which is on the Egypt border. And therefore, Egypt has said, do that and see what the consequences are. So we don't know whether it will be another one like an Israel-Egypt. Now, in that scenario, how much climate financing will actually be playing a role? That I will actually be only procuring for countries who produces clean goods. It's something that we really, really need to watch and observe. Having said so, that doesn't mean that the trade will stop. Trade will continue. Trade will also possibly become regionalized or may continue to be globalized. Trade will definitely, over the last few years, over the last 10 years, 15 years, you will see the trade dimensions or the trade volumes is up. It's octupling. I mean, it's 8 times, 10 times, 12 times increasing. One interesting data is that 25% of the global carbon emissions are actually from the global trade. 25% of the emissions are coming from the global trade. And one USD of the global trade, of course, the X amount of carbon emission that they have been doing in the previous year, every year that X is increasing by 12 to 13%. But the trade will still be continuing. We will therefore be definitely trying to control the carbon emission part and do healthy trading despite the other factors I mentioned. So therefore, what do we now need to do? Let's look at WTO. WTO, if you consider them to be the main body who are helping us and determining the trade policy and all. Now, of course, I mean, many of their mid-century old trade rationals, very much still depending on the welfare tariffs and all, they may not be still so much in a position to accommodate all the new things that are happening in the trading of the goods or data, environment or many other factors. And they are now really working on redefining the trade policies, considering the climate part of it. In fact, maybe the students will be interested also, and you, of course, is a very expert on this, and will be also guiding you. They're also working on the in terms of the trade rules and regulations. They've got the 10 tools of climate financing you can study. They're working on it, they're still not determined it. But the 10 tools of climate financing. So the 10 tools are green customs procedure, that how do I really make everybody under the trade facilitation agreement? I think all the countries want to trade EFA, if they're in the land port. How do I reduce the weight at the land border to reduce the pollution? And therefore, one is they're doing that because these are all coming from the NDCs, you know, those 2B, 15, 21, 28, all the nationally determined contributions, the NDCs from there, they are now determining these tools, the green government procurement. Government procurement actually constitutes 13% of the world GDP. They're asking that every government to follow a standard green government procurement procedures. They're also getting into more regulations and certifications. One is a very important thing that is coming up, and I will spend 2 more minutes here, which is the certification, the carbon footprint product liability standards. How do we measure carbon? How do I really measure the healthiness of the processes? Is there an equivalence of the standards across the countries? There are some global standards, of course, World Bank standards and many other standards, but are the countries mandated to follow that? No, they have their own certifying authorities, they have their own certifying mechanism, there's a private certification also. 2 countries, I think they only follow the state certification, Korea. Most of the countries go to the private certification. But the challenges they are now facing is, how do I measure the carbon? What are the measurement techniques being followed all over the world? What are the governance techniques being followed all over the world? And that is where the CPRs they are now trying to introduce. Even when you are going into the, you all know possibly you all have been aware also the CBAM. Now there are various interpretations of the CBAM. CBAM could be misused also significantly to make the developing countries suffer if we are really not actually interpreting the CBAM. But when we are doing the CBAM also, the measurement techniques if I do not have the proper data disclosure, the climate data directory, the uniform metrics and methodologies, the equivalence of a system in every country, then every such things will be had a chance of being misused also. They are also now getting into the revision of the tariff level, trade financing. Very important aspect is the banking. Banks who are trade finances, non-banks who are also the trade finances. We'll spend a little bit of time on for the financing issues that people are not facing in the climate financing scenario. But the trade financing and how to really bring in appropriate trade financing and how they can also bring in trade financiers together to make the trade financiers understand, the banks or the non-bank trade financiers to understand the ability to the rules and regulations. But of course, keep this in mind that nobody will actually be doing the trade financing considering environment as the only factor. Because the ROI will play a very strong role. But therefore, bringing all of these trade financiers together and bringing them under these rules and regulations of the WTO will also possibly throw up a little bit of a challenge. And then there are three more areas that they are very much working on the WTO 10 tools. In fact, one thing I will be suggesting the students also to explore, a very pioneering work has been done by the ECB and the IMF. They are working on the joint climate information architecture. Now, this is a very interesting thing. I mean, we can also, IIFT can also participate in that. Which is basically, I was just thinking, I mean, not that they exactly agree with thing, but we can think about the Paris rule. The 20% of the global, which is the most important volume or most contributory volume to the world trade, if we actually identify those 20 goods and do that complete the origin destination global value chain mapping of those 20 products, and at every point of their movements into the entire value chain, we measure and check that which are the most contributing points for the carbon. And therefore, how we can direct our financings only to those points to reduce rather than really burning the ocean and boiling the ocean and doing it for the whole world and keeping it as a theory. How this carbon information architecture to be created for 20% and then we can move to the next. Likewise, we can actually cover that. And that's an exercise which will be done, which will be also related to the financing aspect. At the end, when I come just to the last point of the financing part, so one is now related to the policy, which is more coming from the WTO and others also. But the financing we're facing also another challenge. In the last for the Paris Agreement, there was a goal that required 100 billion US dollar per year through public and private finance. We've fallen short of that. We have not been able to generate 100 billion. Public sector or public finances have been able to contribute around 75, contributed only 40. So you have fallen short. Now, the effort must be given where IIFT is given all the MDBs, the multilateral development banks are working on the how this private financing part of all these MDBs, which there of course each one of that is now can be geared up more, and what kind of combinations of funding we can do, loan syndication, better guarantee, different kinds of credit facilities. How do we really create much more innovative? How do we exit from a project which are not so high risk project? How do we so that the private financing is not affecting the other financing like the poverty or the other areas? How do we really have a dissociation between the portfolio and projects? How do we get move privates more toward the return-oriented financing and keep the public part of it more towards the non-return part? So a lot of activities researchers have now been done. And how do we also bring the private equities, not the institutional, the NDBs or the bilateral development banks or their private arm, the private equities, the world's leading VCs also to come and really contribute to this trade financing model. What should be obeyed and how we really can get this additional money which is now to be generated. And for the interested students are getting to the research which is being done, particularly driven by IMF more on creation of a much more smarter financing norms and how do we bring the private financing into the trade financing and private financing into the global trade. Having said so, now coming to the end, so therefore what we see is not to be done, of course. I mean, if the world reaches a steady state, we are all becoming absolutely quite trade-oriented and we do not have any other religious sentiments or any other hegemonic sentiments or any other linguistic sentiments coloring our trade. If we can really go to that kind of a situation, economically well, then there are still something that we will need to do. Number one is we need a carbon accounting standards and the measuring policies and a lot of improvements that we have. We need a clear thoughts of a fundraising between the public and the private. The private financing mechanism, how do we really bring it? We also need a clarity, and possibly when I was discussing with the experts earlier, a clarity on the environment part, which itself now is sometimes being asked and questioned by many leading countries, that we should be more into the climate action or we should be more getting into the adaptive part of the climate. Or thinking that what will happen, we will not be able to control. But how do we move more toward the adaptive part rather than trying to control the climate? Or move more towards the resilience part. So more clarity now needs to be given when the fund of the 100 billion should be more toward controlling the environment or more towards the adaptivity or the adaptive network. So similarly, there are other the policy is a very important thing where WTO now has to really take a very lead role. And how the countries will therefore be cooperating with the WTO rules and regulations, that is something one really needs to do. And coming also to the private corporates, one also needs to see that if I take an example, this is an example of a private organization of whole world economic possibility organization. If you get a big corporation here in India and their entire supply chain, their entire extra supply chain at the layers, it is not that we have been providing a consulting to a very large manufacturing firm, old manufacturing firm. In terms of the carbon emission, they definitely are not too good because they are into a product, they are into a product, they're into a production process. They're also buying some products which all contribute to the carbon emission. Going to them and telling them that you have to reduce it by 15%, 20%, 30%, technically they are willing. They are keen to do so. But the amount of funding and the investment that they will actually have to put in replacing their production system, replacing their material substituting the material substitution, all will actually be taking some time. And more importantly, down the line as we move to the value chain, to the suppliers, as we move down to the more smaller organizations, it will be more and more difficult for them also. So therefore, this trade financing and the supply chain financing will have to play a very important role, keeping all these aspects being clarified with us at one point in mind. The last thing which I should be saying is that while we are pretty tolerant, the gradual destruction of the world, we're pretty tolerant to the gradual, I don't think it will happen in my life, I don't think it will happen in my children's life, so therefore we are tolerant about the gradual destruction. But on the other hand, we are pretty intolerant about the religious beliefs, anybody destructing, destroying my demonic thing, anybody giving me any kind of fear on my immediate existence. If these tolerance parameters and the intolerance would just be swapped, we become a little more intolerant about the environmental part and a little bit more tolerant to the other beliefs and religions. I think we will go for a much healthier world. Thank you very much.
Thank you, sir. Now we'll move on to Jaideep Mukherjee.
Good afternoon, students. Good afternoon, my fellow members, and good afternoon to PSC teachers. On behalf of my organization and on behalf of the, I would say, the so-called quote-unquote sustainable community, I thank IIFT for organizing such a very important topic that we are speaking today. So you have heard from eminent people like Dr. Acharya and Ambudisa in terms of the framework. I gave in with some thought processes, but I changed that thought process and I said, what I'll do is I'll try and give you some more practical examples of GVC and the challenges and the opportunities that might exist from an industry perspective. Because most of you, after passing out of this institute, would be looking to start your career either as an entrepreneur or maybe as a corporate professional, right? So let me take this up and let me currently take you back to some of the thought processes when we started this business way back in 2022. Okay, so the terms called sustainability, net zero, something that we are not very sure about. In 2022, I remember that day on 26th of February 2022, when we incorporated the company, really I was not really aware of all these terms. It just looked bleak and lacking to me because I come from a hardcore IT background and I'm an IT consultant for 30 plus years. So these things are something which I was never aware of. But today, this is something very interesting, far more interesting than IT. And I will ask some few basic questions and probably I'll give the answers also. For you to make this presentation slightly more lively and probably to get your attention out of lunch that probably you have to gone through. I'm sure it was a pretty heavy lunch. Okay. So the word sustainability is something, it is like a huge thing. So if you look at the moment you talk about literature, literature is a huge subject, right? So sustainability, if I put it in a category of a subject, it's a huge subject. And we deal with a very small portion of it, which is called the EV ecosystem. I don't call it an EV, I call it an EV ecosystem. Now, this is an ecosystem which gives you a return or gives you a visibility very fast. You heard about sustainability, like you are talking about carbon credits, the carbon exchange that Ambudisa was talking about being set up, the norms being set up. But when we try to do something, for example, I remember way back in 1999 or maybe in 2020 or 2000, suddenly we got started, my parents came back and said suddenly they got started charging 50 paisa more for diesel and petrol. And the reason behind that was the golden water capital was being built or being planned. And really people were not aware what the hell is all this about. Why am I supposed to pay 50 paisa per liter for that? Now today we all know the benefits of golden water capital, right? And probably we are one of the countries which is overtaking in terms of creating highways much higher than even the US. We build more than 147 kilometers of highway every day, and we all know the benefits. So we did not look into it. So there is something called feasible and something called visible. Now, EV ecosystem is something which is very easily visible. Why? Because it caters to two major areas of the globe, which is the transportation and the logistics sector. And I'll give you a very quick example. All of us are using it day in and day out. How many of you use Amazon, Flipkart, Myntra of the world? Right? You get a delivery back at your home. the last mile connectivity delivery for most of these organizations have been converted into sustainable delivery methodology, which is the EV. They use a battery powered vehicle to deliver, be it a two-wheeler, three-wheeler, or a four-wheeler. Everybody is very happy. So I'm making my country green, I'm making my city green. Okay, I'm reducing pollution. But I'll also now give you the other side of the story. The battery that goes into it is coming out of lithium ion. Now, to create lithium ion, the amount of pollution that you do is unheard of, or probably unmeasurable. Second thing, you are charging that vehicle powered by fossil fuel, probably fired by the coal that you fire in either Kolkata or Bangalore or maybe in Maratha, right? So if you look at that net zero, ultimate result is zero. I'm not telling you that, but it looks like apparently when you put your calculations on a piece of paper and try to do the maths, the balance sheet will be in such a condition that you probably will say, boss, this balance sheet doesn't look good. However, in terms of your visibility and marketing perspective, what happens is you create a huge brand image that you are a sustainable organization, you create that. So what does that imply? That implies two things. Shall we get into that or shall we not get into it? The answer is definitely yes. But let me just take this piece and from here let me start the discussion and probably give you a new thought process out of it. This creates an opportunity and this is linked to the GBC that Professor Acharya is talking about. So let me give you some of the examples of what we are trying to say. Today, lithium ion is one of the components which is the highest amount of battery that gets energy. And today in India, if you buy any EV vehicle, whether it's a four-wheeler, two-wheeler, three-wheeler, a bus, truck, whatever, not a single piece of battery, a lithium ion battery is manufactured in India. Not a single piece, not a single gram of lithium ion is manufactured in India. There is a news that there has been availability of lithium in Jammu and Kashmir. There is another informed news that Rio Tinto, the world's largest mining company, has been probably awarded the contract to mine that out. But when it's going to come and when we are going to get our own lithium ion is something that's questionable. So in terms of geopolitics, China today enjoys the largest amount of lithium. They control the battery market. They have two powerhouses. All the batteries that comes into India are supplied by China. There are two great companies, Great Wall, and another is BYD. These two companies supplies the batteries in India. And if you want to stop the trade with China, then what happens is your battery, you have to start producing on your own. Now, in this kind of situations, what happens is people are forced into innovation. When we were facing the war, when we were hit with COVID, India never produced PPE kits. India never produced oxygen, I would say, these generators, okay? Now everything we have started producing on our own because we felt the need to do that. So today, what has happened is lithium ions non-availability and lithium ions possible in terms of getting those, I would say, polluting components. Today there is a huge push and I'm not sure how many of you are aware of. There is an alternate that has come in and it is now being proved better than lithium ion, except there is some density issue that industry is trying to work on. It's not sodium ion. Now in terms of availability of sodium, just think of this availability of sodium in India. India is covered by 3 sides, it's covered by the sea. So sodium is not a problem in terms of your availability. And it goes back, way back, even before our independence, if you look at the Dandi March and all that. So that's something, so you can relate it back. So sodium ion is a possibility. Second thing, the another possibility. Today you have the manufacturing facility slowly coming up in areas where Professor Acharya was talking about China being the factory of the world. I spent a lot of time personally in China between 2005 to 2017. I have seen the ground. And how they manufacture, it's amazing. We can't do that in India. Let's be very clear about it. It's not possible for us to do it in India. However, the type of manufacturing facilities that are getting set up in India in the automobile space is also mind-blowing. Today, how many of you knows that Tesla has a Calcutta connection? How many of you in this room? Tesla will have a Calcutta connection. Tesla is on the verge of identifying the location for starting their first ever factory in India. All of you might have heard it, right? Okay. The first collaboration that has happened is Mercedes-Benz has said, you are welcome to come into India and use our chargers and not to bring in Tesla chargers. That's one. Second thing, a company called Ramakrishna Forging, based out of Calcutta, have been already approved by Tesla to provide the entire forged equipment that will be getting into the Tesla. So we are talking about opportunities which will be in a separate kind of a global value chain that's going to be coming into the market as the dynamics will keep on changing. The IT industry, which I have been through, why did it come to India? A lot of people say it's a lot of the quality of manpower that's available in India. We have super brains and all that. Point taken. But does that mean that the Silicon Valley in the US is all a bunch of buddhas? No. The hard reality is it costs them $200 per hour. It costs $6 per hour in India. That's the reality. Let's face it. Okay. So, and then suddenly what happens is, then you saw Bangalore coming up as a boom because Bangalore became one of the cheapest. Then Bangalore slowly started getting expensive, moved to Mysore. Mysore suddenly started getting costlier, moved to Coimbatore. Okay. So that's how the whole value chain is going to be moving on and on and on. So if you look at today in the EV, I would say EV ecosystem today, we have a couple of big time opportunities for India to be on the global space. The areas are, we can be one of the biggest manufacturing hubs. And just to give you an example that we work with a company in India, it's called Stellantis. Stellantis owns 14 brands in the world. 7 European brands and 7 US brands. I will leave it for you to find out which are the brands, but I will just tell you, Stellantis has a manufacturing unit in India and they manufacture a product in India which we use in Calcutta, of which 75% of the manufacturing is exported from India as EV vehicles. Only 25% of the vehicles are sold in India. Citroën. It's a French vehicle. Okay? Yes, and Jeep is part of Stellantis. Definitely is. So, and they have created 2 mega factories in India, which is only manufacturing the EC3 platform. And on EC3 platform, there are a lot of new vehicles that are going to come in. Now, the localization of EC3 in India is up to 70%. That's 30%, of which 10% is the BMS and 20% is the battery, is not available in India. So India has a huge scope in terms of the global value chain to set up the next alternative biggest battery manufacturing center in India. Second, another battery, I will come to it. The second most important part of it is the policies that we were talking about. So if you are aware, I was in DTI last week on BP, there was a big time meeting and we were informed that there are 5 companies that have been shortlisted. 5 companies have been shortlisted to create world's biggest giga-powered battery manufacturing facility in India. 5 companies, you can check them on the web or you can check them in the newspapers. One of them is from Calcutta. It's exciting. Okay? It's exciting. And there is Amron, which is Amazon batteries. And there are 2 other big names which I don't need to tell you all know them. Okay? So these 4 companies plus there is 1 company which is coming in. Ford is coming back in India. Okay? I'm a hardcore Ford user and I'm a hardcore Ford fan. Ford is coming back into India and out of the 7 products that they are launching, 5 of them would be EVs. Okay. So the India is definitely changing the EV space. Why I'm telling you, EV space is going to change because, as I told you, that there are certain things which are visible, there are certain things which are not visible for us from a marketing perspective. Because end of the day, if Tesla comes here, Tesla is not going to give you the technology. Tesla is going to provide you and place you on the global value chain, and it will put Indian companies which become suppliers to Tesla in India will become global suppliers to EV manufacturers like Volkswagen, Volvo and others in the entire world. So automatically the value chain goes, beyond the country, beyond the boundaries, and you become it. So that's one of it. But there is a con of it also. Why? Because lithium ion continues to be the killer. And then end of the day, you will start looking at the fossil powered or fossil fired electrical systems basically firing up your EV vehicles. So we need to be careful in terms of taking that call as to how do we benchmark and how do we balance this overall, I would say, sustainability that we are talking about. In terms of manufacturing, I told you that there will be a large opportunity for particularly the ecosystem players that works in India who support these global players. And all these global players would be able to support. Maruti is coming up, in fact, Suzuki, I will not say Maruti, it's Suzuki is coming up with this first ever EV platform. And once this EV platform is rolled out, the advantage would be that all these players would be able to basically then export their components to the Suzuki plants across the globe. So that's another value chain that we will be able to see. For me, I see India in a slightly different perspective, and I see a lot of innovation plays coming into the picture. With this global value chain coming and the way it is being derived, and particularly with the new startup ecosystem that's also in the country, I see a lot of new innovation and new stuffs. New innovation stuffs would be coming and hitting me, and probably giving me an opportunity. We'll be happy to take questions probably later in the day to give you those options. 10 minutes is too short probably to tell you. But overall, let me close this speech by telling you that on the EV ecosystem, getting into the global value chain would be typically very easy because there is a push, there is a mandate by the government, both the central government and the various state governments in terms of adoption of EVs. They have a clearly laid down, at least the central government has a clearly laid down roadmap between 25, 26 till 2030. Some of the state governments in form of their policies have that in place. This will help in terms of creating large manufacturing facilities, large facilities for the OEMs and their other ancillary vendors to get into the global value chain. Subsequently, one example would be creating one of the largest EV manufacturing facility in Odisha. If you are aware of, JSW has just signed the project in the state of Odisha. So this will open up, and this definitely will open up innovation and will provide a lot of opportunities for bright students like us. With that, I probably close my speech out here and look forward to interacting with it. Thank you.
Thank you. Prachi, now we'll move on to Mr. Ajay Bandyopadhyay for his speech. Thank you, Professor Ashwini, for giving me this opportunity. I'm really humbled and honored to come back to the Institute and discuss about this very interesting topic on climate finance and global value chain. I should start with saying that, as some of the previous speakers also mentioned, that these two are not really very interlinked topics because climate finance as a topic has its own dynamics, has its own way of looking at things to address climate change. This is one of the biggest global problems in this generation. And then we have the trade policy, trade finance, the global value chain, the trade and investment dynamics which are there. And definitely, it's not a very neat thinking that more and more global trade have contributed to the global emissions in the world. If the investments which are happening in the different countries are not green, that would continue to pollute the atmosphere, that would continue to put more and more carbon dioxide into the atmosphere. But what is new is that what are the different financial innovations or the instruments which are going to be made available to the economies of the world, both to the public sector as well as to the private sector, to address some of these challenges. And frankly speaking, even today, neither to the multilateral development banks or multilateral institutions, nor to the government, nor to private sector, large commercial banks, really have very accurate financial tools to move the needle. Whatever is available are predominantly very traditional debt and equity instruments. And of course, the carbon market, which has gone through the several ups and downs last several decades, which definitely have contributed or made certain success in this whole journey. But as we see the reports from United Nations and many other broad institutions, that what we are doing in terms of climate change is just minuscule, just tip of the iceberg, and we don't really know whether we would be able to make any considerable difference in the whole journey before the whole world gets destroyed. So what I would do, I would probably like to spend a little bit of time to talk about the general landscape of the climate finance, both from the global perspective as well as from India perspective, where we stand, and then trying to find a kind of an interlinkage between GBC and the climate finance, that what are the various climate finance tools and instruments which can make the GBC cleaner, and considering the fact that there are various layers of GBC, various composition of GBCs which are available today, especially after the world is experiencing several crises. So if you look at the climate finance volume, and when we say climate finance, it's essentially some kind of finance which are available at a concessional terms, so to say, or the cheaper terms, to make the climate, so-called the climate projects more viable. That's as simple as it is in the definition. Because when we say the climate projects, it sometimes requires certain technologies which are more expensive than the traditional ones, which have not yet received or achieved the commercialization appropriately. So in order to make the accelerated commercialization at a much faster rate than the rate at which their previous generation technologies have achieved commercialization, you really need to make certain market conditions. You probably need certain policies so that more and more people get access to this technology, more industries get access to this technology, or the entrepreneurs who are investing in those technologies, they find a cheaper capital to deploy to make those projects more and more viable. And that's the whole crux of the climate finance, that we need certain pot of finance which are concessional, cheaper, or having a longer tenure, or rather more feasible for the entrepreneur to access than the traditional finance which is available by the commercial banks or many other commercial entities. So if you look at some of the big numbers, that according to the International Energy Agency, that today the total investment need to meet the target of decarbonize or to make the energy sector alone low carbon or zero carbon is US dollar 3.5 trillion per year. And I'm talking about, it's a global number. This can also go up. And per year, this is the investment which is required, which will continue to be required in the next 10 years or 2 or 3 decades. When we look at the Indian scenario, the amount of funding that is required to make India net zero by 2070, which is the minister's goal, is nearly 10.1 US dollar trillion. Now, this is also a very, very significant amount, and this amount is just talking about the so-called carbon reduction projects, which we also term as a mitigation projects. It is not talking about what Mr. Dasgupta also talked about, the projects which are climate adaptive projects or the resilient projects, which will make the infrastructure, make the economy more resilient to the climate shocks. And if we add that number to this number, it will probably go to 2 times or 3 times, because that's a really hard infrastructure finance that would require to make the economy more climate shock resistant. Now, where will this money come from? If you look at the global scenario, especially post-COVID, the kind of fiscal stress that each and every governments are going through. Then there are the geopolitical tensions. Then there are supply chain disruptions. The energy prices have considerably gone up in many of the countries, leading to higher food inflation and creating an inflationary situation. That has significantly shrunk the fiscal space for most of the government to spend. And there are immense maneuvering that how do we prioritize
among the global challenges. So there are the challenges to target global poverty. There are challenges to target the geopolitical situations. There are challenges to target the industrialization, and there is a climate change. And the problem with the climate change is that it's no one's steady. Everybody thinks that the other country is contributing more than what I am doing. So this is no doubt that the worldwide institutions have come to a conclusions that 2/3 of the entire need for to meet the climate targets, which was sort of discussed, deliberated, and the world came to a consensus in the Paris Climate Agreement in 2015, that has to come from the private capital sources. Now, again, the challenge is, what are those private capital sources? Are these the banks? Now, post-Lehman financial crisis, the banks are not really in a stage to expand their balance sheets to a significant level. But then there are hopes. There are also different avenues from where the climate finance is going. One big avenue are the philanthropic capital, which are being contributed heavily by many of the big companies. You've heard about the Gates Foundation, Breakthrough Energy, which is promoted by Bill Gates to invest in some of the breakthrough technologies. Then Elon Musk Foundation and many other similar foundations which are working globally on the different development projects, and climate change is one of the major focus of these philanthropic capital. Then, of course, there are venture capitals, the private equities, who are coming at various stages of the project. And certainly there are commercial banks under which a lot of regulatory pressures are being put by the various jurisdictions to squeeze their balance sheet to enhance the availability of the climate finance. And so are the multilateral institutions like the World Bank, ADB, African Development Bank, who are being tremendously pushed by the different countries, the G7 and the G20, to augment the whole corpus of the climate finance. Now, coming to the point that what is the interlinkages with the GVC and the climate finance, and how climate finance can make the GVCs more competitive and more sustainable. Post 2008, we have seen that the GVCs across the world have already seen a very dramatic reorientation. Before 2008, there was a different whole construct of the globalization. The world was becoming more globalized till the point when the Lehman crisis really hit hard the ground. Many of the poorer countries, they actually benefited from the GVCs. Instead of developing the whole industries from the scratch, they sort of hooked up with one or two parts of the elements of the global value chain. But then today, if you see at the global value chain, there are a lot of different terminologies, a lot of different orientations which are emerging. People are talking about friend-shoring or near-shoring, which is sort of squeezing the entire global value chain in a much more regional or national construct. There are the advent of the new technologies like 3D printing, automation, and AI, which is bringing back certain parts of the global value chain which were outsourced to the home countries. So you would find that the shoes which are manufactured by Nike, which earlier used to get manufactured in some of the countries like Vietnam and Bangladesh and Myanmar, those are being produced now even in the United States or in the advanced countries at a very similar cost level. And this is the trend which is going to get further accelerated. We are also seeing many products which are coming from not from the virgin material, but from the recycled material. And as we are seeing this recycling circular economy is taking the shape, this is also creating a very different trade dynamics. The ease of trading of the virgin material versus the recycling material is very different. There are a lot of policy restrictions which are there across jurisdictions, across the developed countries, preventing the trade of the recycled materials across the globe. And this is adding one more dynamics to the GVC. Third, today, most of the industries which are operating as a part of GVC or otherwise, facing pressure from the investors who are pushing them to be more ESG compliant, environmental, social, and governance. There are regulations which Mr. Dasgupta also mentioned, which is CBAM, the Carbon Border Adjustment Mechanism, which is asking now the 5 category of industries to decarbonize their operations to having the low carbon products if they want to export to the European Union. And this is just the starting, they are saying, although there are a lot of political pushback across the world, that how this whole regulation will come, in what form, shape, we don't know. But certainly it is reorienting the earlier definition of the global value chain. So global value chain is no longer as free as it was originally perceived. It has come to a much more concentrated form, and it is going to be in a much more concentrated form going forward. Therefore, those industries which are relatively non-clean, which are carbon intensive, which are energy intensive, and those part of the global value chains which are more carbon intensive, they are pretty much at the risk. So if they don't decarbonize, they basically lose their competitiveness, especially for selling their product to the developed market. And in a sense, they're going to incur higher cost, lose the market to the more low carbon producers. On the other hand, if you see, there are a lot of technologies where the cost is rapidly coming down. So the cost of producing power through the solar technologies, through wind, through electric vehicle, we mentioned, then green hydrogen, carbon capture, and utilization and the storage. So these are all the new generation breakthrough technologies which have its own global value chain. And we see there is a consistent decline in the cost of many of these technologies. So for a country, how to capitalize some of these developments? So we have seen even in India, the government of India have introduced those ELI schemes to localize the value chains of some of these cleaner technologies. That amount is not very significant today, but we have seen today how the United States government post-COVID, as a part of their Inflation Reduction Act, has introduced very high level of the stimulus to promote some of these so-called nascent industries, the green hydrogen and carbon capture and storage and so on and so forth. Having said that, it is also true what has been done in the United States cannot be replicated all across the world. Second thing, this entire subsidy has its own limitations unless the market itself comes to the point to take care of itself. Otherwise, the development is going to stop at some point of time. But the crux of the story is that there is a need both for both policy intervention, regulatory intervention, as well as the financial tools, financial instruments to make the firms competitive to participate in some of these new generation of the global value chains. Next thing, we are not talking about those breakthrough technologies. We are talking about the traditional industries. We often term those as hard to abate sectors, the steel, chemical, cement, then oil and gas, where the process is by itself is energy intensive, and beyond certain level, you cannot really reduce carbon emissions with the traditional set of technologies. Now, but you definitely need to clean those up to make the GVC more competitive, more sustainable over a period of time. So, what are those financial instruments which are really available, to do that? And the last but not the least is the whole supply chain. Now, today we see that the world-leading MNCs, they are basically contributing to the very large part of the global emissions. And there is a study by World Bank Group, which I should quote here, that the 157 large MNCs across the world actually contribute to the 60% of the world's global emissions. And these MNCs are not by themselves, but in their supply chain. So if you need to control the global emissions, it's not enough to finance some of those MNCs for their own operations, because their operations are all well distributed. But there has to be certain mechanism so that these MNCs, through these MNCs, we can channelize the low-cost finance to their suppliers, And these agencies, by virtue of their by the development status and by virtue of their technological and intellectual property strength, can work back with the suppliers to make them more competitive and agreed. Now, since we don't have much time, I would rather end it with three main financial instruments which many of the worldwide financial institutions are talking about. Number one is the blended finance and the concessional finance, and which is the term we would keep on hearing today in many deliberations, policy or even the financial sector, which essentially means that you blend the commercial capital with certain non-commercial or the grant capital, or to structure a project in such a way so that till the time a technology reaches certain maturity, you do the piloting demonstration with the help of the grant finance, and then subsequently as the market starts taking off, then you start putting concessional finance, and then you leave it to the hardcore commercial finance to take this off. So this is the structuring and more nuanced discretionary investment, pushing investment across the various chains of low carbon technology chain. So this is precisely what blended finance is all about. There are a lot of discussions how government of India can negotiate higher pot of blended finance from the global community, and many of the institutions are part of that. The second one is the transition finance, which is very, very interesting, and many of these terms are also coined by the large banks like Goldman Sachs and Morgan Stanley. So they are saying that, well, now developing countries cannot really move from where they are today to a low carbon or a zero carbon status tomorrow. So you need to traverse certain path, the transition path. And the choices it will make in terms of technology, in terms of market, customer, are really capital intensive. So what are those different financial tools you really can access so that today you don't need to jump from a brown to green, but you can go from a brown to less brown to gray and to finally to green. And there are instruments like transition bonds, transition loans, which are very selectively being piloted by many of the financial institutions to move the needle towards a more zero carbon path. And the last one I would talk about is the green supply chain finance. And this is again coming in various forms. From the World Bank, we are now working with 16, 17 large MNCs, including the one, say, for example, Microsoft or even Airbus, Nike, Adidas, and few of the companies. So what we are doing, we are saying that, okay, we will finance some of these large companies because they have a good balance sheet, they have a good fiduciary system to manage their finance. But you need to really set certain target with your suppliers that by next 10 years or 15 years, they would actually move their operations to a more sustainable roadmap. And the fund that you would provide would come with that conditionality, that it would set certain targets to their suppliers, it would provide the knowledge, capital, technology, all these different supports. There will be complete monitoring, data transparency, how your suppliers are behaving. And at the end of the tenure of this finance, we will actually monitor the entire development impact of this whole journey. So this is a green supply chain finance, but again, it's the tip of the iceberg. There is a real dearth of the supply chain finance available in the emerging market. Apart from the traditional banks, there are emergence of various supply chain finance platforms which are trying to crowdsource pooling funds from the different domains to make this happen. And I would end here. The last area which very briefly I would cover, that is, in spite of all we talk about, but International Energy Agency is saying that today 48 to 50% of the emission reduction has to come from technologies which are in the prototype or the innovation stage. So we need the startups, we need R&Ds to push the things through. We really need to make that changes happen. And the whole financial architecture which is needed to promote those deep tech ventures, what we talked about today, are very different. So they need so-called the patient capital, which has a longer tenure, which has a lower interest rate. They need the corporate venture capitals. Sometimes even the normal venture capital industries are too risky they find it too risky to provide that things. And
So that startup financing in various forms and shape, especially looking at those clean tech domain, needs to really grow up to make the real things on the ground. Because today there are a lot of innovation coming, not just from traditional public R&D, but from the various startups on the ground. We see some of these tractions even in the Indian market. So thank you so much for this opportunity. I think these are very broad and interesting topic, and not can be deliberated on this. Thank you.
So we are through with the initial remarks by our esteemed panelists. Now I am opening the floor for questions. Raise your hand and then you can remind that Satish.
I have a couple of questions. First one is to Mr. Najim. So, regarding the lithium ion batteries, what was really interesting was that for mining lithium, we also are polluting a lot. So, there's also another question of greenwashing. So, if the net carbon emissions in the lifetime of a battery is higher than, let's say, what the traditional fuels are, while the intentions are still correct, while the intentions are still green, does that at some point become termed as greenwashing? Is that a thing that we need to be aware of? Secondly, this question is in general, is that, like Mr. Bandyopadhyay said, and also Dr. Acharya said, that GVCs are integral to this, but let's say the developing economies are more preferring, prefer the green technologies a lot more. So when procuring from less developed economies, is there a chance of adverse selection? And does that mean that GVCs have a certain bias towards moving towards developed economies in the future? And is there an inequality there? Thank you.
I'll probably answer the first one and leave the second question for others, but then if required, I'll come. Today, one of us are talking about data, right? And then we take a call based on. So, the importance of data in today's world is humongous. As far as our own research and our own team of people that we are working on, just to give you an example, the benefits to be able to actually come back to you and tell you in based on ground reality probably will take another couple of more years to probably give you an actual answer. If I keep that answer aside and probably tell you Excel based or maybe any kind of AI tool based answer at this point of the time, which always possible. Now, there are differences in realities. I'll give you a quick example. EV operating in 42 degrees Celsius and an EV operating at 4 degrees Celsius makes a whole lot of a difference in terms of the life of our ecosystem of an EV. Obviously, the emission levels, maybe we don't even know where the batteries are coming from which particular mine. We as a consumer is not concerned, but definitely there will be a set of people who will be concerned to figure out where the lithium has been taken out, what was the level of pollution that was addressed, and what was the greenwashing that was taken. So it's not an effort that I pick up data from A, B, and C and just put it in an Excel or maybe in an analytical tool and give you that answer. It requires a holistic approach in terms of integrated, acceptable standards, okay, which all of us are talking about. Once we have that, probably the answer would be, to give you a correct answer, probably I'll take another couple of years. But on paper, if you tell me today, that's definitely possible.
Next question that GVC adverse selection. That's what you asked. Yeah.
I think that's the main problem you see. I was talking about just the technology, but this is another technology, the green technology. We don't have. Apart from what Mr. Amrit was talking about very pertinent question of geopolitical thing. And this is my take when after the LSE conflict, line of actual control, we started thinking about shutting doors on imports of many parts and components of electrical and electronic goods to India. You know, semiconductor. Then I was contemplating to change my earlier U9 card to another one. I had a waiting time of 5 months because semiconductors were not being allowed to import it from China. So that is one feasible point. Now what he was talking about is another dimension. If the global value chains are also requiring, it is true, and we need to, that they should be based on the green capital, green production technology. Where do we have access to that? So basically, you are taking out a large chunk of developing country. You just don't take China, India, Brazil, etc. as the representative of the developing world, right? So there's a large chunk of developing world who will be outside the purview of the GVC. And whatever the GVC benefits will be there, will be concentrated, further concentrated in the developed countries. So what the GVCs will be delivering. And one particular thing that we are all missing out, we're talking about emissions during production. I gave you a figure that is 8.5 times one intermediate who is roaming around. What about the emissions during the transportation? It's the manufacturing, right? It's not a virtual trade where transmission is very little. Fortunately, we still transport goods through sea, which is much cleaner. But now we are moving towards, because we want to cut short our time, air transport. 10% of global trade, as far as my memory goes, 10% of world transport is by air transport. It's very growing rapidly. Yes, and it is growing very rapidly. And that's very energy intensive and carbon. So one has to think about this, what the GVCs are delivering. We just don't focus on the production side, but also the delivery.
Any other questions? Yeah, are you glad? So, okay, so in the time they think, I have one question. That is, you can say that. So you have talked about various kind of financing agreements. Now, so then you also talked about, these can be bonds or something. What about, so what we have seen, normally also it's the case that there are many SMEs and might be they are more polluted. But for a single SME, it is very difficult to ask them to, adopt a technology. So we have many kinds of, things where we see that the common facility centers. I have done some projects where, and then there is something called viability gap funding and all those. So from that point of view, don't you think that you said that maybe two-thirds may be coming from the private, but don't you think the government should actually be the first to come up, like always when it might not be viable for the private, then it is always wrong. Can't we keep that logic?
No, I mean, theoretically that is true, but the point is that the overall landscape of the climate finance is shifting so much. He mentioned that this $100 billion endowment that Paris climate agreement talked about. We are not even near to the $10 billion. In the previous climate conference, we talked about loss and damage fund, especially to mitigate the losses due to climate shocks. There is no certainty from where even a single dollar will come into that fund. Okay, now the thing is that there was always the political headwinds, the geopolitical issues, the debt crises and other things which have pushed back the government finance. Even the international flow of finance, which is by and large coming from the different developed countries, those were also got constrained because of these issues. So while it is true that especially to take care of those SMEs, there is a need for a different type of financial architecture, but the sources of finance could be anything. Now, certainly, there are various platforms which have emerged, especially in the emerging economies, and the things which I talked about, the supply chain finance. which directly or indirectly takes care of the need for the SMEs to access not only finance, because finance is not just the only problem for them. They have the problem for the availability of the knowledge, best practices, and also the technology. So that can be further mobilized, through some of these platforms.
Any other question? No? Okay, I think. Oh, there's someone. Oh, I didn't see. Yes, okay.
When we are talking about clean technologies, how can we employ? When we are talking about clean technologies, how can we? I mean, is there any way we can employ more decentralized approaches to technology in order to bring about strengthening or concentration of the GVCs? Like more decentralized approaches like adoption of blockchain.
Blockchains.
Yeah, and what is the scope in India in regarding that adoption of decentralized technology?
Something to be writing. I wanted to understand the question slightly better. You were talking about manufacturing technologies, right? And then you were talking about blockchain, and then you were suddenly talking about decentralization, right? So just wanted to be clear that by decentralization, what do you mean?
If you're talking about more green technologies, can we take a more decentralized approach to that?
Decentralized in what sense? Delegation of power, ability to take a decision whether to go for the technology. Is that what
adopting blockchain technologies maybe, or what is the role, if at all it plays any role?
See, I would refrain from getting into blockchain because I'm not able to put a connection to that at this point of time. But what I'm trying to tell you is that if you are talking about a green technology today, traditionally India as a country, our technologies, we have reached a state, I think, where we can say that we have started picking up, creating our either own technologies or trying to adopt or be able to actually import the technology into India. And that's going to be only the economy is only going to go northwards. If that is what is understood by all of us. The technology that we are trying to talk about in terms of mass production or critical manufacturing industry today. One such example is the automotive industry, where it is heavily dependent on manufacturing 4.0, implementation of IoT, technologies like blockchain and all that. Now, these technologies are something which is already available globally with some of the manufacturing channels. Okay, particularly the vehicle manufacturers who are based out of Germany, no opinions and all. So, they have already brought that technology into India. So it's not a question of whether we want to decentralize it further. Now, the question that probably you wanted to ask is that, probably I may be the person, what I thought about was that you are trying to say that in terms of adopting a green technology, should there be a kind of no limitation or barrier, probably, for us to take it forward? Maybe what you meant by that. I was not very clear on the question. And just to give you my thoughts on that was one of the question. Today, I think adoption of technology and what we are forgetting before we get into all of this. Would you look at anybody who wants to come into a country or for that matter picks up a market, they obviously look at the market size. Now, obviously, I will not go to Vietnam and start creating a market unless I have a plan that 70% of my production is going to be exported. But if you look at India, the market size anyway is one of the biggest in the world. Okay. So what you do is you create a facility in India, and with the current policy of Make in India, current policy of self-reliance and whatever we are talking about, then what happens is more and more ecosystem that you are building in India, that gets integrated to that parent company or that global company. For example, today, Tata Motors is not an Indian company anymore. It's a global company. So Tata Motors has their biggest battery research facility in Glasgow. They are pumping in one of the largest investments in the UK in terms of battery manufacturing, probably the second largest battery manufacturing plant in the world. So we work very closely with Tata Motors, so we know. The entire R&D platform of JLR is being explored by the engineers of Tata Motors. So technology is something which has become global. Technology and work exchange has become global. Now, it all boils down to end of the day that whether it is cheaper and it is easier to manufacture them in India, so that we can also address the Indian market as well as export it out to the global market. If this dynamics works, I don't think there will be any problems for anyone to come in and operate in this market. However said, Mr. Dasgupta, with his experience in management consulting, would be much better placed to answer some of the questions when it comes to policies and certain decisions. And as Professor Acharya said, that there are certain things at a geopolitical level which is beyond our control. So we might be thinking, if I need to go to Dalhousie, I can go straight, but why the hell am I not going? Okay, so those questions are typical questions which we cannot answer, or there is no answer to that.
Okay, so yeah.
I think he has raised a very good thought. It may not be coming out properly in the form of a question, but the thought you are trying to put down is if a componentization of a manufacturing process, splitting a manufacturing process into many components, decentralizing the productions from various things and having blockchain to give the traceability of who is produced that, will that be able to reduce the carbon emission? It's a thought based on which I was just trying to indicate or just trying to allude to the carbon information architecture, which is being researched on and done now by IMF and ECB. It's to some extent like that if some product in a large factory is being produced and the carbon emission there is huge, is there a possible to isolate out the components which are producing much bigger carbon than the other parts, and then split it out into such components, take that out in a kind of physically a different factory or a different place, and create that architecture to see through a blockchain that traceability that which one is basically contributing more, and therefore do not throw out the entire product. So isolate it out but do not discard the whole product. Figure out which exactly is the problematic area. Now, question you have raised is very pertinent or good part. Answers that have been raised is very vague. The reason being, this is very much research now, and people do not know whether this kind of a carbon information architecture. This is also related to the financing, because if that kind of an architecture can be produced, and when I mentioned that 20% of the products, if that could be more, that can go to the analysis by applying the Pareto. Those particular areas where the pollution or the carbon emission is much more, whether the funding, rather than for the whole organization or for the whole factory, would be more pinpointed and focused on that specific, more carbon emitting thing. That is why they're working more on the carbon information architecture, because it's a needed fund, and how we can really pinpoint those things.
Okay, so I think we can, if you have any further questions, we can take it later. Now we have to wrap up the session, and I hand over and I thank all the experts for taking out time from their very busy schedule and coming here and discussing very pertinent issues and really the issues which we don't discuss in class. So we need to what you need to know. So now I hand over the session to Geeta.
I thank all of the panelists and Vivek sir for this amazing panel discussion today. On behalf of the student community, we are very grateful for your enlightening, awareness-inducing and very thought-provoking solutions, and also the negatives that you all left us to ponder with. The objective of this panel discussion was to have an overall understanding of what sort of policies that India can go for. And I think we have been able to gather quite a few of them. And I would like to summarize it in very short for us so that we can take them up in our future endeavors. So number one is that India can develop its comparative advantage by increasing effective foreign trade agreements or other free trade agreements, which can protect our import competing sectors from facing steep competition. The second thing is that we need to build a carbon information directory for India so that climate financing strategies like carbon tax are not barriers for Indian exporters. The third is that India can look to innovate in sodium-ion batteries to power the EV ecosystem of the world. And given the fact that India is currently building very efficient automobile manufacturing, we can upscale India's GDP participation in other sectors by becoming EV battery manufacturer. The final insights are that when we talk about climate finance, innovating and investing in startups with tools such as blended finance provide a way for the future for us to move into a more sustainable and green future. Thank you everyone for attending. We would give a vote of thanks to our professors and the support of the administrative staff today to make this panel discussion possible. Thank you very much. For everyone, high tea has been served outside. For the events, people who are participating in events, we have the second round of quiz and the final round of debate after the high tea. Thank you very much. Please look forward to those. Finally, I would like to present the mementos to our panelists. First up, we have the memento for Professor Rajat Acharya. Then we have a memento for Mr. Amburish Dashgupta. Then we would like to present a memento to Mr. Joydeep Mukherjee. So you can go to the IIFT logo. A memento for Mr. Ajay Bandyopadhyay. And finally, a memento for Professor Vivek Roy Chaudhary. I request all the IES members to come up on stage very quickly for a group photo. And of course, our faculty. Now, of course, please. You all are very dear to me.
Yes, come, we have a photo.
Carry coach तो আমি jingle drop तो event that words I think for the policy
Okay,